Good morning, everyone. Maybe someone from Zoom can confirm that you can hear us.
Yes, we can hear you.
Perfect. Thank you, Elvis. All right. Let's kick our startup module sessions. For this week, we'll dive in deeper in a topic called fundraising and also funding to go through the possible funding opportunities out there, understanding how they differ and on which ones specifically for your team you should focus on when you will think about fundraising. And also this will give you a better understanding of the whole funding picture to prepare some maybe questions for tomorrow's discussion where Anna Andersson, Anders K. Berziņš, and also Mikus Krams will have a discussion about fundraising, how to approach it from investors' perspective and also from companies' perspective and founders' perspective. So yeah, write down any questions you have. Definitely use a chance to ask questions for Viesturs today, as he has huge background in fundraising and also not only founding his own companies and fundraising for them, but also helping other teams, especially in early stages, to approach investors, angel investors, VCs, and also public some grants. So use a chance to, ask questions and get most out of it. And do you want to share the fun fact, or should I?
Fun fact, yeah. Okay, I'm not sure it's on purpose. Hey guys, and hopefully I'm heard as well, right? You can hear me on the other side.
Yes, we can hear
perfect.
you.
Yeah, right. I think it's just by pure coincidence, but Janis told me this morning that I had an honor doing the first keynote with you on this startup module, and this is kind of the last one. So the circle is closing. And not that many of you here. Yeah, Elvi, exactly. So not that many of you are here, but that very plenty of you, like 30 plus people are out there. I think that's the result of the crippling sports activities you had yesterday. I remember again quoting my famous source of quote, Winston Churchill, and that he was asked why, because he was, became in 50s the second time the Prime Minister of UK in an age of about 89 or something, and he was asked how can you be so mentally fit? He said, okay, I don't know, I drank a lot and smoked a lot, but yeah, there's one thing, I've never done sports. So yeah, that's always encourages me, because I hate that too. Okay, right. So my invitation to you is ask questions when they come, okay? Because this is, I will go, there is kind of, there is lots of ground to cover. However, I think we have 3 hours or so. So I will really go at the pace you want, and you ask the questions and clarify the terms and everything as we go. Because obviously, and I will try to look into try to turn my back to see whether there have been some questions coming, and there is something already in the chat, which I probably, okay, this is just about starting time. Okay, good, yeah. And probably if some of you are on Zoom, they let me know that the questions are appearing there, because it's behind my back, literally. Okay, good. Yeah, Janis already told that I have some experience both in raising for my startups and investing in other people's startups, both as a business angel, we talked about what's that, and as well as run a early stage, very small, like a boutique early stage fund back like 15 years or so. So I've been on both sides, and then also worked with lots of startups in helping them to understand and not screw things up in the first place, because not screwing up is easier than fixing things, and I would always suggest you try not doing it there. Okay, let's go then. which means that this was some weird thing here. I think I know what's the idea. The idea is to put the pointer there. Okay, I would start with a quote, and probably you know who Paul Graham is, and there is actually a link on to his blog kind of site that's not exactly well seen contrast, but there is. Okay, Paul Graham is one of the founders and one of the early people working in arguably the most famous world's accelerator program, Y Combinator. He's one of those 3 people actually started. His now wife and Sam Altman, I think, were the 3 who started it, working actively. And Paul Graham's blog is cool thing to read because he writes in a wide subject, about a wide area of subjects, from founders issues to raising kids to writing code to politics. And so it's an interesting piece of read if you have fancy reading things. And that's his quote that actually basically startups tend to mismanage all the funding process and screw that up even more than other things, which they definitely do as well. Okay, silly question, kind of comes back to where we started. How are you if you'd been asked, what is the main thing of a startup?
To survive.
Very good. Very good. Do we have some answers from other side? What is the, if you, just for you, in a simple, keep it simple, what is the simplest way how you put what is the main thing of a startup or any actually young company? Pardon, growth, yeah, okay, survival, growth, say it again. Revenues, okay, very good, perfect. You're studying hard so far. I'm just we'll play around with this. Okay, yeah, basically you said it. The main thing of a startup, very cynically saying, is to find a working business model before you run out of the cash. Bang. Because if you run out of the cash, and then still the cars can go in a tailwind downhill, but that's what we call enthusiasm, but it's up ended, and then you have to think of other things. So basically, and you do it in 2 ways. Again, super simple, super cynical. You can accomplish this one in 2 ways. It's either you get the paying customers early, right? Someone pays for you to then experiment and iterate and maybe fine-tune your business model. Some maybe you're early into the time-wise close to the market, and that's where that's where your cash is coming from. And congratulations if that's the case, but that's not necessarily very frequently the case if you need to build something rather serious. And the second is securing sufficient funding in elsewhere. Okay, so basically, if we think of the first keynote I was doing here a few months ago, we were touching upon the figuring out the product market fit, and now we're for the second. So I'm doing the main things the startup needs. I'm doing the content and the main things the startup needs to do with you guys, both of them. Okay. Well, now, just I think we touched upon that, but maybe we didn't. No, actually, I think we're supposed to. Let's talk. So first of all, let's talk about funding landscape. So meaning what is out there, and how you can think of what is relevant and what's available and accessible to you and what's not, because there is a certain way to think about it. And the first variable to think about what funding is available and needed is the concept of scalability of business model. I'm back. I think we talked about that. Yeah, we did. Thank you. Because that's one of the most powerful concepts ever, if we think about entrepreneurship at large, not only about startups, what I kind of try to also think about and try to sort of position or put the businesses and different business models in. Okay, so basically, just to recap, there are two types on the ends of this ruler. There are two types of business models, or two types of businesses, or two types of entrepreneurial activity. One is called linear, which means that you're close to market, you can start offering your service or product quickly, selling it, getting revenues, growing organically. But the linearity rests in the fact that each next absolute linearity, in case of absolute linearity, each next of the items sold has pretty the same fixed, variable or direct cost, right? If you do something twice as much as you did yesterday, you're incurring twice as much of expense, direct expense. Think of, once again, all sorts of tailored products or services, professional services, right? The more you do, you have two customers as a lawyer, you pretty much spend twice as much, give or take. The time is with one, and etc. And on the other side, there is the scalable business model where you're far away from the market. You have to build something first. You have to code or solder or whatever is there, prepare. But then, and that's why you are technically unable getting customers immediately. So you need to spend money. And there's also sizable risks, bigger risks that you might build something no one needs, because in the first case you can relatively quickly test to the market whether the market needs what you're building or not. Okay, but the other sort of feature of that scalable business model is the scalability per se, which is the definition of not having any direct/variable cost associated with the next sale. So if someone comes and buys 1,000 subscriptions, for example, your direct sales, your direct cost is not increasing. Yes, marketing, acquisition, of course, but this is not exactly okay. If you can later in a game, acquisition cost could be regarded as direct because you can measure it very precisely, but not in the beginning. Okay, this is something just to recap for those of you who probably were not around or anything. Why I'm showing you this, and I like to show this ugly picture for lots of occasions. One is thinking about iterations and getting the product market fit, which is much harder in the case to the right side. We can also have it has implications on how you build teams, but this was not my territory for start school, how you do all the co-founder thing and everything. And but the third thing, which is really there's a huge difference depending where you are on this scale, is in funding and fundraising per se. So what I'm trying to do is I would try to sort of a map or picture all possible most used, most kind of frequent funding instruments out there based on these two axes. The horizontal is just the time, but time in terms of developing of your product, your project, your startup, right? You're starting up on the left side, and then like perpetuity, somewhere like maturity of the company is there, just how to interpret what I will be showing you. And then on the vertical axis, there is this turned upside, the ruler, the scale I was showing in the previous slide. So the very linear business models sit down there, like classical small businesses, right? And the very scalable is up there. Okay, I'm just making sure you kind of not lost with my explanation. Okay, wonderful. So let's go. And let's take some lessons out of it. Yeah, and the horizontal axis is is logarithmically drawn, meaning that the first, the further it gets to the right, the more the time shrinks. Okay, just to depict everything in a logical way. Okay, let's start. Rule number one: no matter whether you're building your coffee shop or next Facebook or next to TikTok or whatever you're building, guys, you always start with your own money. That's rule number one. You always have to, it could be sometimes even not that much of a money, but your time, your effort, which is kind of maybe opportunity cost of not doing something else. But basically you have to invest yourselves into what you're trying to do. That is the rule number one, because you have to get to some proof. And I think that's exactly what the Start School is, partly this model is about. You need to get to some proof that you're not daydreaming, that they need it, and everything we spoke about earlier about product market fit, etc. I believe you know what the 3 Fs stand for. Family, friends, fools. Exactly. Family, friends, and fools. There is a politically correct version referring to fools as fans. I like the old version. I think family, friends, fools is more descriptive. And this is, and mind it, being called a fool, in my world at least, is not a kind of derogatory term. Which means, kind of, if I have to give a definition of 3 Fs, the 3 Fs are people who are emotionally vested, primarily emotionally vested into in your success. So they want you to succeed. They might not know all the detail of investing and doing it relatively foolishly, if we look like from the perspective of kind of the investor who is investing repeatedly. This is probably a first few times of the business angels investment is also the 3rd F rather than the business angel. We'll talk in a second, because you don't know exactly what you're doing, sort of technically. Okay, so this is the so it's nothing wrong with being called one of the Fs, because this is largely about, yes, they would like to earn money on you. There's nothing wrong with that. This is not just donation or something in that context. Yes, they have hopes that you will do well, but the primary driver is emotional. Okay, this is my kind of interpretation what the 3 F says. Okay, so you have to get somewhere, you have to have some proof, and depending on how, again, scalable the thing you're building is, the proof may be very different and may require very different types of proof there. Okay, let's move on. The next, which flies into the picture, is business angels. And there will be also a disclaimer, someone can precede them, but this is detailed for the visibility. Okay, rule number 2. Can someone figure out what's the rule number 2? Looking on this visual is ugly. I know, I'm designer -1. Visualization. What is the rule number 2 if we think about it, whether the business angels are going to invest or not? First is, yes, you need to already have some proof. They come relatively early. They are the first, pre-seed and seed, and we talk about the stages in a second in the lingo. This is also kind of important to get the head around what are those fancy names meaning. But can someone deduct what is the rule number 2, except of that they are coming later in a game? Pardon? Bingo. They see there is a gap. You have to be at least somehow scalable and ambitious and potentiality in order to qualify for external investment. Okay, thank you. There is a gap between the bottom of this oval and the horizontal axis. That means that coffee shops are not investable. Okay, or I don't know, externally investable. I mean, not FFFs or close family or something. That means that professional services like accountant, outsourced accountant offices are not investable, okay? Because unless they're maybe, I don't know, train lots of agents nowadays and can scale wildly. That's a different story. But we think about, the classical way how we perceive them. This is the rule number 2. So in order to qualify for external investment, the project has to be at least, and this is very debatable where the line, because it's a picture that is a representation of kind of relativity here. But the project has to be somehow scalable. That is the problem often also with very complicated business models like social entrepreneurship, right? Which are, unless again they're not don't have some scalability element into that, sometimes there is purely rendering services for public good, right? They're not fundable, not investable. Not fundable is different. Not investable externally. Okay, that's the rule number 2. Okay, now this oval of the business angels is quite wide in terms of the verticality, right? So there is a big, just for you to kind of think about that, there's a huge difference between the angels on the top of it, which kind of look for similarly than funds, sometimes look for next Facebooks or TikToks, and in the bottom, which look just for a good ROI. And the thing which will come back also later, where we'll talk about, I unfold all the other ugly ovals there. The more your project and your startup and also types of investors, the more you're positioned to the upper side, to the extreme scalability of huge scalability side, the more in your or sometimes we say the more ambitious are the investors. The more you will be in fundraising process, the more you will have the discussion of you being unicorn. In other words, not about the risks of your project, but about the upside of your project. So no one will kind of be very impressed that you are, this is risk-free investment or whatnot, right? And this signals them that actually you have no upside, because if you have upside, there's this potential of growth, then most likely there are more risks associated with it. Okay, so the more, if you position yourself, if you think about the business model and the startup you're building, the more you are to the upper side of this graph, this map, then the more it will be about your upside, about becoming big. And all the discussion we talk about, also fundraising, vocabulary and practicalities in the end, all the discussion will be centered about, okay, if you really make it, is the segment big enough? Is the niche big enough for you? If you penetrate if you're the market leader of something, is the market there, right? For you to be big. And this is, again, traces us back, to remember product market fit definition, the healthy market. Are you in a healthy market? At a good market? The lower you go on this vertical axis, the more you will be having a discussion of risks, return on investment, like something very tangible and measurable per your project. Because the more your investors sit on the upper side, the more they are not in a cherry picking, but in portfolio building. And this will echo very much with the next thing I will unfold here. They are not that concerned with with the risk of the given project, but they want to diversify into as many projects.
There's also foundation water.
The portfolio is
in the small bottle,
giving you decent returns. Is it something else? Okay. Right. Anyone asked something? Because there was a noise eventually coming from somewhere. Maybe no questions at this point, right, guys? I've got many of you there, like 40. Okay. Right. So that's the idea. That's the principle. You can always also think about it. If you're raising for maybe moderately scalable hardware, for example, hardware is also investment-wise hard, and we talked about that. And second, the more you discuss the risks of the project, the return on investment of the project, the more you raise for something super scalable, the more you discuss the upside and world domination. Okay, kind of obvious also for this. Okay, let's move on. If questions, please ask, and maybe when we show the whole picture, you can have some questions on that. The next thing that flies in a picture is so-called pre-seed and seed funds, and this is pretty much on the horizontal axis. I've drawn them slightly to the right, just for the reason of better visibility. They pretty much, I mean, they coincide in terms of stage. They pretty much coincide with the pre-seed funds, for example. They coincide with the timing and staging of investment of angels. Now, what is the and pre-seed and seed? I just made it shorter for seed, and we talk once again in a second about the stages and how to define them. But the entire idea is that the biggest difference is the business angels are individuals, wealthy, reasonably wealthy individuals that are investing on a regular basis. That is the definition. So one-time investor is the third F rather than the business angel. We spoke about that. Now, and they are investing, those angels are investing their own money, or they syndicate together and also kind of share, like 5 angels pouring sources and investing in 5 fraction, like 20% in 5 companies. This is portfolio building again, the logics of diversifying, but this is their own money. Seed funds and any other, we call them institutional investors, those are the funds who are actually investing primarily their investors' money. They also have a chunk, and that also varies. They have a chunk of their own money, but they are investing other people's money. So their business model is that they raise from investors called LPs, limited partners, because legally it's in most parts of the world, in almost all parts of the world, it's so-called a limited partnership. In Latvian, it's komandīta sabiedrība. For the reason. Komandīta sabiedrība. Yeah, there's we have akciju sabiedrības, we have sabiedrības ar ierobežotu atbildību, and there's special regulation for funds. Most of the funds operate as komandīta sabiedrība in Latvian, and the entire logic says that's legal, but the entire logic is again very obvious, that the managing partners, the management company, has more responsibilities than the limited partners in Latvian komandīta. In the managing partner in Latvian is komplementārs, and the other are komandīti. Doesn't matter. Forget about it. Just entertaining you with the legal terminology. The basic idea is that they have different types, rights, and responsibilities. Either you are just investor or you're managing the money. That is the reason why they are built that way. Because making them all equal in some sort of joint stock company, for example, would be not nice to investors. That's the answer. Okay, so these are institutional investors, and again, the rule number 3, as you can deduct, again, this is for relativity. Most of those institutional investors are even less interested in even like somewhat scalable things, right? See the circle ends quite up to the scalability part. Again, this is kind of visualization which can be like discussed on each and every single case, but the entire idea, what I want to convey here, is that you might be investable for angels, but not necessarily that makes you investable for institutional investors. Why is that? This is because of the business model of funds. Like I said, they're raise money from those LPs, then they're invested in some proportion. They might be like hundreds of investors in one seed fund or VC fund. This is also venture capital, but this is kind of a specifically kind of separated it into the early stage because it's a little bit different rules there, but not that different. So this is their business model is very much in Excel. As sometimes say, because they want to make sure they are very much in portfolio building, as opposed to angels who are somewhere in cherry picking, right? They down there who are want to look at whether, of course, they're not investing in totally the projects they don't understand, and this is not that they're investing in everyone. They're investing maybe in one each 50th or something, as they ask to Andres tomorrow what's the investment to first reach out to investment rate. It's something I think between 50 and 100. So in each 100 they do invest. But the point being here that they are just based on those specific investment theses, what they have, regions, industries, and everything. They're building portfolios. And they're just looking into the situation, okay, that if you are you able to be sufficiently big for us to recover all the other 10 or 9 or whatever, 8 out of 10 investments that will be written off, okay? That's the entire idea of investment of the fund, that they spread the money, in particular the seed funds, and that's the difference between the VCs. They're a little bit different math, but they spread out the money, and then they hope that 1/5 or 1/3 or whatever, what's their hopes, will return at least the principal or have some 10x or 20x or whatever, shoot to the moon. And then they're fine, whatever. And that's the reason, as you see, the portfolio building, that's the reason they don't care that much if someone is not returning the money because someone recovers it. That said, of course, they're not investing into something that they definitely don't believe it will return money, right? It's just carving out those. Okay, so this is the seed funds. Now, sometimes you come across the word of less than 10 years ago, but accelerator programs. So what, again, there's lots of things called in this world similarly and not necessarily mean the same thing, but classically, like American style, like Y Combinator style, accelerator program is nothing more or nothing less than a pre-seed investor with a hands-on program, right? They give you first 100, 200, whatever, thousand, but oblige you to be trained through the program. This is a classical. There are lots of other beasts, and there is accelerators when you want, for example, to relocate. There's so-called sweat investment that they just teach you and don't take the equity or take the equity for in-kind and all things. But basically, the classical American style, Silicon Valley style accelerator is that they give you first pre-seed investment, take some shares, obviously, and then or do the convertible loan, which we'll talk about later, and then you basically also undergo some program, some training. This is a classical kind of thing. It is slowly dying out. It was a super popular because of ascent of Y Combinator as well, but also some other copycats. And I've been part of many accelerator programs in Europe and beyond as a mentor, but they are a little bit less popular now, and I have just a simple kind of hypothesis why. I think there are more and more second-time and third-time founders starting up, as it was like 10-15 years ago. 15 years ago, most of the people starting up were the first-time founders, and obviously the biggest benefit, the biggest benefactors of such training programs are the first-time founders. Again, I think you feel it. That's kind of logical, because if you've done it a few times, you're intelligent enough. At least you'll be doing other mistakes, not the ones you did before. So it's already, you know, benefit of having such a program, going through such a program is limited. Okay, any questions? Not too boring? No?
I have a question. So
yeah, go.
Like second or third time founders, they don't want to join accelerators, they just want to get money. That's it. That is the answer.
So the question is whether the second or third time founders don't want to join accelerators and just want the money. Yes, but also the investors sometimes don't see, because if doing acceleration is a costly exercise, and if I'm a pre-seed investor, which can give the money to whomever, and this is also kind of a question whether maybe I just give the money and let's not spend the money, because it's money spent at the investor's side, right? Doing and running a proper accelerator program, maybe we're still better off just giving the money. Okay, some will learn from the others, and maybe we'll better do just networking and beer more frequently with our portfolio companies, and it will work. So it's both sides. It's not necessarily only the founders are reluctant, but sometimes the investors also don't see much of a reason, if you're serial founder, to force you going through the acceleration. There are exceptions sometimes. Sometimes, exactly like I said, there are programs, for example, what's the name, for God's sake, the guys in Sunnyvale? Plug and Play, yeah. Plug and Play. There is another important player, Plug and Play accelerator in Sunnyvale, California. And they have two things. One is the corporate innovation and corporate programs. Plug and Play is famous for, and matching, startups with corporates and that stuff, for example, as enterprise products or something. And the other thing Plug and Play was quite famous, at least up to recent, was that they were also organizing these, if there is European or Asian, mostly Chinese, of course, because the activity of starting up is much bigger there than here. If they want to flip to the States, for example, the United States is regarded their primary market, then they would also do programs for these flipovers, where which is kind of a cool thing, that if, for example, even I'm serial founder from Europe, go and participate in a program in the US to understand the market better, to have introductions to the US. It's kind of, I think we're taking even I don't remember the business model. I don't think that was a stake in the company. That was more of a participation fee. You pay them, meaning, I don't know, 10 or 20K, and then you run through a quick program to show how the world in the States work. Again, we can have debate on how efficient it is, but for some, I would say it probably is very helpful, especially if you have a start, for example, for a bit later stage startups who have established to have the home market in Europe or Asia, and then they want to internationalize, and with all the similarities, at least Northern Europe and States have lots of similarities. We're probably the luckiest in terms of cracking the code, but still we operate slightly differently than these guys said. It's sometimes helpful.
Sorry. Oh, okay.
So for us, okay, we went through Start School, good education program,
Yep.
Great, but still that might be good for us as first-time founders to join.
Yep.
Accelerate.
Yeah, it might be good. The keyword is might, but yeah, I'm not denying it. It might be good for you to join Accelerator program, which is focused specifically, not that coding and this and that, which is cool, hands down. But to help you to kind of streamline you building your startup, yeah, and launching and everything, because it's about mostly the classical one is that pre-seed part, right? When you go from your idea into getting to the market, not necessarily launching, but getting to the market. Yeah.
Continuing this topic, what's your opinion on sectoral accelerator?
Okay, the question was. Yeah, I'm repeating because you're not mic'd. The question was, what is this sector-specific kind of accelerator opinion? Germans are super strong in that, and some also Swedes are strong in that. I would say that this is something. There are two answers to that. One is that it's often defined by the investment thesis of investor. If it's an in-house accelerator, sometimes nowadays we start seeing also acceleration as a service. Then some organizations, like for example, Startup House, we have the idea, by the way, offer to early stage investors acceleration as a service. So we can take lots of different early stage first-time founder teams and help them to actually with some soft ass kicking, right? That's one thing. But if it's an in-house accelerator of a pre-seed or seed investment fund, sometimes they are sector specific, and then it's defined by just their investment thesis. It could be very broad, like just B2B SaaS, which is, I think, everything. And in Northern Europe, it's pretty much like everything is B2B SaaS. Or this is more specific, like it could be, I've seen in Germany, Denmark, I've seen Norway, it's all this maritime industry related, because they're big in there, right? I've seen other things. That is, so this is first, that is probably because out of their investment thesis, they want just to nurture those. Now, what is my opinion? I think, as with all accelerator programs, there are good ones and bad ones. The success of accelerator, I think there are three, this is my subjective take, and I came up just by answering the question, but I think there are three things that matter in the success of any accelerator program, as also early stage investor. One is the pool of applicants, because if you have a selection like Y Combinator, where people like just wait for years and iterate their ideas to get in, you always, if they have a competition at the entrance, you always will be having a much more quality crowd, and a better crowd implies a better result every time. You can screw it by doing nothing with these people, but technically you have a head start already with that. So one thing is the pool, and that's often the problem. For example, in Baltic accelerator, you used to be, and they pretty much skipping all the early stage investors. I think none of them is keeping a proper accelerator. There's some people call things acceleration, but it's not exactly the acceleration. This is the problem, because the deal flow is as it is. So this is already, you have not covered that. And for all the public mandates, which is an early stage investment in Baltics, largely publicly funded, right? You also have the mandate restriction. You can't take the super cool company from Romania or Georgia or Portugal. Often that's the problem. That always is a problem, that public money shrinks the mandate to whatever is here, and that is against the competition. Now, that's one prerequisite. The other prerequisite, of course, is the quality of the program itself. You have to work, you have to have a structure. I'm still an old schooler, but I think you have to have certain structure built in, and you have to make sure you tick the boxes. It's not just keeping you around and serving you free beer and ping pong nights. It's much more than that, right? And the third thing is the quality of network, which again, it's a little bit against the Baltics, because the quality of network, because what matters is the mentor network, but also all the introductions you can make to particular industries, particular bigger companies, managements, and everything, because it's just, helping you. One thing is, because if you start your startup, it's already too late. In my humble opinion, it's too late to just learn the things that you're learning here. You have to move. In particular, if you have raised the pre-seed, it's like raising investment is putting your startup on steroids. You can't go slow. You have to start running, for good or bad. So basically, it's too late to teach you about product market fit and everything. And I've done it in some accelerators, and I have this double feeling, because they also invite me in Estonia and in some other parts of Denmark, of Europe. And I went like always, isn't that, come on, you invested in them and you want me to tell the things they actually were supposed to know. when they were approaching you. And this is not the arrogance from my side. I feel it's that's why we're doing here also in a startup house and similarly to your model, so-called pre-acceleration, which is exactly, you're on your own, you haven't incorporated yet, you maybe don't have a team full and everything, and then you learn the ropes. That is the time to learn the ropes. And then later you start applying things. And then not that much of a content, but this one-on-one, your intellectual ping pong with mentors, like challenging you, plus the intros are the critical. So those three things I think are the good accelerated programs for not such good. I hope I answered.
Your answer was interesting.
yeah, right. Okay, that's but the same goes again. Summarizing down to what you said, same goes also I think with sectoral. With some do the job and some don't. So not yeah. Okay, David has a question. Perfect. I see you.
Yeah, thank you. Do you hear me clearly?
Yeah, quite well.
Awesome, thank you. So I have a question about this graphic. So to my understanding, the AI is coming quickly, and this graphic could be wrong, right? Because you need money capital for HR for the headcount, right? And now in the new AI era, you don't need much capital since you don't need HR to scale because you can use a lot of AI. So I'm asking you, what are your thoughts on that? Because I just saw an article like this morning, and YC there will be they are actually giving a lot of money for a big valuation right now because it kind of looks like that they're scared as well that capital won't be needed as much anymore. So VCs are kind of like panicking about that. So what are your thoughts about that?
Beautiful question. Thank you, David. Yeah, I think it will change. I think it will change the landscape. I will still believe the principles and those how to put it, those all these spots and ovals I've drawn, they will stay there. Maybe they will conflate or something. But I would personally think that it will take less money. You know, that is the answer. The logics will stay. Maybe if you needed to raise $1 million for a seed round, you would be okay with 200,000 now, right? But it's still further from market. You still might need some money, but you're absolutely right. I think the VC industry is the one shift was happening. One shift already was happening in terms of investment scale and stage, and that's how exactly those early stage investors appeared. Because up to, I would say, up to end of 90s, maybe up to .com, right, bubble, there was very much one type of VC, right, which did everything and did very large, write large checks. But because of the PC, you know, ascent of all that thing and ascent of internet first, it democratized the development, the software development. It democratized. It was really when, I don't know, Apple started or something, there were really millions needed to ship some product out, right? Then it became a few hundred, thousands. Then it, of course, inflated again because of, you know, people become more expensive and whatnot. And I think that is exactly, and even more severely, the AI will change the landscape. It just not that much of money will be needed from the VCs. Yeah, well, and VCs have, just to finish off, and the VCs have to change the business model into maybe some other value-adding services, like so-called smart money, right? Intros, contacts, networks. It still will matter very much. So maybe, actually, nice idea, maybe all the software programs, not the pure money, will come back again. It will have a renaissance.
Yeah, well, you know, in my opinion, I think that the leverage the startups will have a lot of leverage. The true startups who will innovate things, right? Because the VCs will fight a lot to get the startup in the early beginnings. I just saw that the YC Combinator, the newest batch, will give 2 million on 30 million plus money, which is a really big, really good deal. And it kind of signals that the earliest rounds will be the most important, because there will not be anymore a lot of big rounds, in my opinion.
Well, there is yes and no. This depends also. The need for the subsequent rounds largely depends on your business model, on the acquisition need to have an acquisition cost. But we'll talk about that later. But this was a beautiful remark. Thank you for that. And I'm largely sharing the opinion that the VCs have to rethink their business models in like right now, because it's not just exactly about the money, and they're losing the leverage of being able to pick. That's very right. Very
true. That's a nice thought. Yeah. Thank you.
Fully agree to that. But once again, that said, I think they will still be there. It just the deal terms and everything will change, and maybe the amounts and involvement will change. Okay, cheers. Thank you. Okay, let's move on. Right. So we spoke about seed funds. Let's complete the picture. Now, the next thing which flies in the picture is the classical, like we call sometimes them in a slang, lettered round, like A, B, C rounds, right? Venture capital. And the rule, another rule which we can pick here is that up to now, again, let's see how the AI and the capital intensity will change it. But the rule here, as you see, that if you have raised a seed or pre-seed, whatever you call it, round, you are most likely supposed to raise the VC round, which means that if you're building, in other words, if you're building something really scalable, most likely one round is not enough, because one round is to get to the market and then to expand and to fund your growth. This is the classical VC, yeah? So this is, which means, again, that sometimes if there are way more many startups raising the seed rounds than the ones who are raising the subsequent, the second or third round, which implies that most likely things have gone south in one or other way. Either you have just figured out that you're not that scalable, change of the business model. You thought you're subscription-based software, but it appears that you have to onboard and teach, I don't know, all of your potential customers, and that efficiently descales your business model. Or you just haven't survived to do it. You actually have flopped because you're raising on the premise that you're doing something, but you failed in one or other way. The team has fallen apart and whatnot. So basically that is the idea. Now, both and collectively, you can refer to all of them as the venture capital funds in this picture, both the seed funds and venture capital. Now, these type of funds, they rarely, I would say never, but of course there are exceptions, they're never / rarely are looking for dividends. They're only focused on the exit value. Why is that? Very, very common sense answer. Why the venture capital / seed funds are focusing on the exit, on that 10x or whatever x, and never ever discuss, with a few exceptions, never ever discuss having any dividends out of the
multiplication game.
Exactly. If you're really growing fast, if you're really doubling, year on year or something, it would be in a value. I mean, it would be the most silliest thing to take some part of that money out, because there is no other chance of doubling the money at the same speed you're having, just keeping it in. Obvious. So this is not the situation where anyone will ask for dividends. But then there is a different type of funds, and this is, it's not like a startup gameplay already. It's in a maturity, and it sits somewhere in mid of scalability. This so-called PE funds or private equity funds, and those are different funds. They have been around for almost 100 years, actually more, but like regularly almost 100 years. And actually, those were the first industry, by the way, where the PE as direct investor appeared was movies, Hollywood. Because this, if you think for a while, the same logics. You fund many, because the movie industry was different in 30s of the last century. You fund many movies, and then one is the blockbuster. Nowadays, they calculate, they pre-see the, like, there is the stakes to fail are too high. They're built, but sometimes in 30s and 40s and 50s in the golden era of Hollywood, they built like hundreds of movies each studio a year, and then some of them survived until now, and some of them were blockbusters, and most of them were flops. So basically, the same portfolio building logics applied back then. But that's just a fun fact. Okay. The private equity funds, on contrary, as you can see, they're sitting much later in the game. So you have to have already predictable revenue streams. And they are just, and as opposed to seed and venture capital funds, they can refinance. Those guys are never, ever, again, with few exceptions, they try not to buy someone out, someone previous investor or something. They just pour in the new money. The private equity funds can do both. They can give you money, and they can buy out the previous investors to some, or even founders as well, to some extent. And this is the different beast. And these are the guys who are sitting, because the venture capital funds are there for 5, 7, 10 max years, because they have the fund cycle, the fund life. Private equity funds are mostly either very, very long term, or sometimes those evergreen in perpetuity, so they can buy, like invest in the company and sit there for tens and hundreds eventually years. Okay, so different beast. They are the ones who look for dividends. They invest in later. They rarely take the risks of super scalable things, but they also require some level of maybe not scalability at that point, but some level of healthy growth and development prospect. Okay, just for comparison, this is venture funds are very tiny niche of all the direct investment funds in existence. Private equity funds are much bigger in terms of size and quantity. All right, the next thing where you can raise money. And this is, I'm talking about not liquidity that much, but the fundraising. The stock exchange, if you're big and if you're in a certain territory, which is not necessarily Baltics, you can go public. You can do an IPO. And the difference between IPO and floating is that an IPO gives not only liquidity to existing shares, but also issues new shares offered to public. And the floating is just trading your existing shares without no capital influx, just terminologically. And this is also, but this is costly. You have to be really big to do that. But in theory, you can raise money later there. And as you see, it's drawn on an angle, on a purpose, because if you are very scalable, you can get, in terms of your development cycle as a team, as a company, you can get into the stock exchange much sooner than maybe some big manufacturing company or something like that. Okay, we're close to the ending this part. Now, then there is newcomer, because if you look here, then there is a gap, obviously, in the middle, kind of mid scalable things. After, you know, friends, family, fools, founders, and sometimes maybe some angels, there is a gap in funding. A typical thing is hardware manufacturing, which still is, you know, relatively scalable. Some things, IoTs maybe or something. This is the kind of, you can think, but not only that in terms of the business model. So there is a gap, and then there has been a newcomer, well, not that a newcomer, but about the not more than like, I think regularly like 6-7 years in existence, so-called revenue-based finance. And the revenue-based finances can take for both of equity, of investment, and as well as loans. So that's why I'm just very broadly defining it here. And the entire idea of revenue-based finance instruments is the following, that they are less, how to say, focused on this X return at the liquidity. They are more into earning out their investment or loan gradually. So basically the idea is that they give you money in one or other form, and then when you have a cash flow, then part of the cash flow is automatically redirected to repaying, either if that's an investment until it reaches some, I don't know, 2x or 3x, and if it's a loan, then of course based on whatever the loan terms are. Now, it has been made possible largely because of the automating of finance, all this PS2 or whatever, those things where you can actually give access to the third party to withdraw things from your like corporate account, for example, and everything. It has been quite, I kind of like the idea because it gives the space for investment for someone who are clearly flying below the radar of classical institutional investors. Because then you can structure it in a way that the upside is less, smaller for a fund, but also risks are relatively smaller because they can control maybe your cash flow and everything. It has given, at least in my not direct experience, but what I've seen, it has given a good possibility to fund particularly the hardware manufacturing, that type of projects with this type of finance. Okay, just to mention that there's no blanks in the funding landscape part. Okay, and then I just, for comparison, this is largely about the investment, but then for comparison, I just am showing that the bank loans sit approximately here. And there are two rules out of this oval. The first is that if you are relatively linear, you can access because most likely the cash flows are predictable sooner, and you can, and most of occasions you can also have some liquidity in your pledge. Maybe you have machinery or something within your some assets that could be pledged as a collateral. So these are bank loans are accessible to relatively less scalable businesses much sooner than to next TikToks and Facebooks. They're approximately the same time when they can go on a stock exchange, or give or take. That was the idea. But the second lesson out of this oval is that still there are super linear things like, for example, the professional services, right, which are not bankable at all. So don't expect that the banks will give much of loans to even a very well-doing, consultancy, for example, or something there, because it's just sits in a head in a head of the founder or partners, and it's not much to be funded by a loan. Okay. Yes.
But in principle, if you just take a loan at a higher interest rate, then you can shift it more, like in your diagram, to the up. So in principle, you can find a sweet spot where you get access to funding earlier as a startup, but just at a higher interest rate. In your experience, have you seen any successful cases where startups, I was just revenue based?
No, it could be also the very edge, this upper left edge of this bank loan. No, I would say that I think because of No, you can take, again, if you're brave enough or stupid enough, depends how you call yourself. You can of course pledge. You can give your personal guarantees and take the loan in the name of the startup, like credit card loan or something. Yeah, it's basically doable. I would advise against it. That's a different matter, because things can go really south if you move up the risk slash scalability thing.
But do you have any like personal experiences or like stories you've heard from you or from like this thing working out or not working out, like real case?
Well, banks are not. No, of course I can think of situations where there have been bridge kind of loans, like kind of credit facility which bridged. Sometimes I never spoke about that, but it's a different matter. Sometimes you're out of your runway, and you need to bridge your funding to some next round coming. It's a super high risk strategy, but you can probably go and pledge your. So, as my dear Monty Pythons would say, sell your children to scientific experiments and get some money in a bank. I would advise against it. I think it's again, depends, because you're vested, you want the thing to succeed, and sometimes you do really very, very desperate moves. And to say that banks in principle do not lend to startups, and that's a good thing, because if I would be a depositor at the bank who lends to startups which succeed every 10th time, I won't be the happiest depositor. They won't be the very happiest person. So I remember like 20 years ago, 15 years ago, there was this debate in this society. Luckily, it's vanished. It's a silly debate that, yeah, banks don't lend, to startups or young companies per se and everything. And so those bastards, and depends what position you take. So I would say, banks would not, unless, like I said, unless you go and say, okay, I have this, beautiful summer house in Jurmala, and I'm happy to give this as a pledge, for my startup. Banks would say, yeah. And it also depends what banks. That's before the 2007 2008, everyone will be excited. Now also they have learned their lesson. What if that beautiful summer house is not worth the amount they expected to be worth now? Anyways, so I would say yes, I've constantly seeing some bridge or desperate moves in terms of taking out like personal guaranteed loans and stuff. It's not healthy. It just means that you're desperate. Bank money, of course, is the cheapest you can have in the world, except of stolen money, and that's also debatable whether you're caught or not. Bank money is the cheapest money out there. Even the junior loans, we talk about this non-collateral loans like credit facilities, like those overdrafts and whatnot, right? Bank money is the cheapest, because all the other money is way more. Well, the credit card loans already are matching. This is what, 15, 16 per annum or something. Even probably 20. But the idea is that, of course, the bank money is the cheapest any company can have. It's much cheaper than shareholders' equity, because you are expecting, think for it for a while, right? If you have been familiar with the weighted average cost of capital concept, the cost of capital in a company, then of course the shareholders expect bigger return. Like you invested this 3,000 or 30,000 in your company. Of course, you're just aggregately, not immediately, but aggregately over the period of time, like your investors or yourselves, you expect a bigger return than those probably, I don't know, 10 or 9 or whatever percent the bank is taking for even non-collateral, right, loan. So bank is cheap money, but the tiny little problem is that because of the risk profile up there, they would not, that's the idea of this graph. They're not going to fund startups in particular, but largely any young companies before they have repeated revenue streams, which are at least somehow predictable. Nothing's predictable in this world, but to the full. But they have, it would, if banks would lend, that would be, yeah, of course, go for it. It's cheap. It's cheapest money you can have. But banks won't lend for a good reason. They are balancing their risks. Again, we can debate whether the Baltic banks are more reluctant than, I don't know, Scandinavian banks or Italian banks. That's it. But this is already a very professional discussion in tradition and in the KPIs, the banks at large, the shareholders put to the banks in those regions, different agenda. But other than that, yeah, I'm not sure if I answered, but that is the reason. You just can't have banks money unless you're, willing to.
I was shooting for a different direction because I feel in the startup space, like the bank loans are very underplayed because there's a VC heavy bias like towards funding.
But they are not available. It's not under. They're just not available, and that's why the VC was invented, because banks don't lend for a good reason, for a legitimate reason. It's not like banks are stepping back because the VCs are there. No, VCs were born and the private equity was born because banks didn't fund it. And like I said, I think it's very, very, very good that they're not funding it from my depositor's perspective. Yes.
Just a random comment. I looked it up, and it seems like Airbnb maxed out credit cards for 25,000 before they got their first funding, and Google founders maxed out 3 credit cards for 15,000 to buy servers.
Yeah.
So
it works.
It works. It's just like 20% interest rate.
No, it's still okay-ish, but it works. But there is the biased data, because on top of those two, we don't know those 2,000 who went down with flying colors and had the vacated out of their flats and the wives left them, etc., and they lived in the street. We don't have that part of the data. But you're absolutely right. That's what I'm saying. I'm seeing it's also constantly here that people try to somehow make ends meet, because you have to live to the next milestone. It's just a risky strategy. That is what I'm saying. It's absolutely true. It's happening. Yeah.
The side question, speaking of banks, does it matter for a startup in which bank to open a corporate account? Because you have like those bigger ones.
Yeah, 3, 4, yeah.
When we have those smaller corporate.
Yeah. Okay. The question was, does it matter which bank you use, for example, in case of Latvia? Not that much, I would say. Again, this is sometimes, most of times I've seen the choice of bank, it's just the bank like maybe as a retail customer, or maybe your previous company was there. And I've experienced back working with altogether some 6 banks in Latvia, 7 maybe, all over the last 25 years. Currently, I have relationships with 3. Some sort of accounts, or not much more than that. Both private and my company accounts. I don't know. They have been, for example, there was the Silicon Valley Bank, which went bankrupt, by the way, in pandemics. There was a particular, they built, it was more of a branding thing, but it worked. They built in California, the SVB, Silicon Valley Bank. And that was like, and also when I had my companies in the States, we had the account in SVB. It was more of a, showing off that if you have an account in Silicon Valley Bank, which means that you're probably a startup, because they were actually vetting. There was some idea behind them that they were open, but they was just, accounts payable. It wasn't, we didn't have any credit facility there, nothing, because we just had offices in the States and we need to have a bank account there. But I was also having, I think, Chase Manhattan, yeah, but that was for a different reason. Maybe even my personal, don't remember anymore. So the idea is that was, but they were vetting it. It's kind of, we came and said, hey, we want to So you open the account with SVB, and they went, okay, what are you guys building? And you're supposed to be, or you're supposed to play being a startup or something like that. Yes, of course, if you have, again, some stable cash flows, but this, opposed to that, they were said that they had a very bit, more proactive position into funding or like lending to something. I haven't experienced myself, but we were never there because it was a subsidiary. That's also a big idea. It was a subsidiary of a Latvian company back then. We didn't flip it to the Delaware C Corp because we were in a process, but that was stopped. So this is, again, the reason we never would be eligible for any borrowing, because as a subsidiary, or would never, but in longer in the history, because this is the same logics as with investment. In the very end, I touch upon that. There's very logics as with investment that you're, if it's all the money goes into the mother company, into the main company. It's not. It's very weird if someone kind of invests into a subsidiary, because that's the matter of profit and cost centers, and then all the transactional pricing and whatnot. Okay, this is it.
Sorry, I have a quick question.
Yeah.
What is your opinion about Altum?
Well, that's interesting. This is a kind of market distortion, probably a good way. I've used actually some Altum guarantees, and I actually defaulted on those guarantees, by the way, with my, no, not me, but my one of the startups back then. And I would say I think it's not a bad thing to have it. Because there are also lots of, and I will be touching upon a bit later about that. There's lots of, there's grant turning loans, right? If you behave, then the third of the loan turns into a not repayable grant, which is always a nice carrot, right? To consider them. They're more expensive. They still take private guarantees. As far as I have heard, they have limiting them, because the entire idea with the biggest, but this is very subjective, don't take it with a pinch of salt. Back then, my biggest criticism towards Altum was that they were actually just a bit more expensive bank. They were branding them as helpers. They were just more expensive bank, and they took your private guarantees. And for me, it's a big no-no. Again, it's not like a never, but should be some sort of proportion. I can't, if I go out and ask them, $1 million of a loan on, I don't know, 8% per annum, because they're expensive, and they say, okay, yeah, fine, but then of course you have to tick all the boxes, the bureaucracy and so whatnot, and plus, yeah, and among other things, and just guarantee it privately. And I would go, no, never. Period. But answering you, maybe I sidetracked myself. Answering your question, I think it's good. I think they are, of course, they have this public mandate funding whatever they think is needed. Like there was all the household energy efficiency thing and whatnot. I would suggest always to look what they have, because some instruments are really tiny. Up to 7, up to 10K, and they're not that bureaucratic. And guaranteeing 10K is pretty much the credit card loan, like equivalent of in terms of your exposure, right? You're not exposing yourself to million or whatnot. I would say I'm not buying that there are as much as a different as any bank. However, they have some of those products that none others have, like this. Yeah. There's this is so always follow what they have and look how much of risks and exposures you may have with them and may not. So I'm not saying it's not kind of a pure evil or something. I'm just.
In the end, like loan is the loan, and you could pay it back.
Yep.
What's about the seed funds and business angels? What happens if you go bankrupt?
Depends. They might be nothing happens. They might have some rules upon it. For example, just spoiling. We're having a break now, but then we continue with the terminology. There is this thing as so-called liquidation preferences. That, for example, if you go bankrupt, that many, not most, but definitely many of these early stage investors would require that the first, if you sell your, I don't know, tables, chairs, and computers, if you go bankrupt, that they have the first right on all the proceeds from bankruptcy until they reach, for example, this 1x their principal investment. Some have bigger X's, and this is, I think, this becomes nasty. Sometimes, for example, you exit, but not a great number. You exit for a couple of tens of millions, like 30 millions. And the last investor had, invested in 10 million in you, and you have a 30 million exit. And they had 2x liquidation preference or something like that. Whatever. And then you go like 20 goes to them, then 10 is distributed among, all your other earlier investors, and then you end up in maybe with 10,000 euros after 10 years of your struggle. It happens, and in the press, it's all great exit to Siemens, like 30 mil, and for the founders, it's like, yeah, whatever. We just have a reputation of having an exit, which can help us with the second time, raising the second time round with our next idea. Yeah.
About this liquidation exit, I understand it's usually an exit, right? But can it be also limited in time? For example, they plan to have a liquidation exit, for example, 2x in 5 years. Yeah. But if it's happened earlier, then they receive less than 2x.
No, liquidation preferences is stipulated. This is if this is somehow either, and there are lots of things. It could be only the liquidation. It may not be related to the exit.
Oh yeah, okay.
It might be if it's a bankruptcy.
Yeah, I mean more.
But most of times, these preferences matter in all event, not only liquidation, but all events of liquidity. So if you're just sell the company, most of times they will look into what was required. So they can. So basically, there is some sort of protection. So that is what is happening. But if you don't have much of those, nothing is happening. You're not. Of course, that's what an investment is. Investment is the funding of the newly issued shares. That's what definition of investment is. So if the shares are worth nothing, then the investors have lost the say proportionally to you. No, there's no consequence. It some investors might think that, again, then it traces back how the company was run, and some investors definitely might have argument with the founders and the team that you maybe were not running it a good faith or whatever. But that's a different story, and then you may get blacklisted or something, but not for the very fact that you have going bankrupt. It's no, but most, even in this part of the world already, it's more than it's more a good thing than a bad thing, actually. If you're done, everything's fine and not screwed anyone.
It's better to gain investors' money, don't take loans, and own nothing.
No, it's better. Okay, one thing. Let's end with and then we have take a bit break, 10 minutes or so. I would suggest that always remember this, what I started, how you can climb the mountain, how you can secure your cash, either by having customers or by having, investment. I would say, think of and this is probably nicely echoes the David's question or comment in the same way. Think of investment as a necessary evil to get to the top of the mountain. If you can climb the mountain without raising, just purely bootstrap, go ahead. I doubt, though, that there will be, because of the business model and ambition and scale, I doubt there will be that many of the occasions where you really would be able to accomplish that. But there are examples. Again, we can quote a few examples who have never raised and built multi-million, billion companies, right?
MailChimp.
So I would say that think always of the investment not as a vanity measure. Sometimes you're also pressurized. You read, oh, these guys raised 4 million. Oh, these guys raised 2.5 million, or girls, or not, right? And you went like as an early startup. Yeah. This is a sign of success. Oh, you have to raise 2 million. I'm sucker or what? No. Investment is just means, not ends, getting you to your ends. And I would suggest maybe the nice way to finish the first part, always think it that way. And don't fall into this social vanity trap of raising for the sake of raising. Yes, the money can help you expand faster, but this is, again, the more money you raise, the more on steroids you are, the less you can slow down and maybe pivot. It's close to impossible to having a huge pivot even if you're seeing you're running into the wrong direction. If you have raised substantial amount of money, because the investors are sort of requiring the speed of action from you. Maybe not the pre-seed, seed before you hit the market is different. But then later, the lettered rounds, that's just about efficiency that becomes. And this is sometimes difficult. If you see that things change in the market and you want to respond to it, it's not impossible, but it's much harder for you to change the direction. So think again, investment's cool, and there's an industry for that. And there's lots of things. We'll also talk the vocabulary in after the break and how to think about that and some practicalities in the end. But this is not this is not the goal. This is not ends. This is just means. One of those two means in combination that will get you to the goal. And as one very smart person once said, that if you have this opportunity strategically, always go for customers, because paying customers will bring you investors sooner or later, but never the other way around, at least directly. All right, that's it. Okay, David has a hand, and then we end in style.
Yeah, thank you. Very beautiful said. And then I want to ask you about, so to my experience, a lot of founders are looking at the VC game like a gamified version of getting to the next round, and next one, right? But what do you think about the logic that you always should look at the round you're actually getting, like the last one that you will ever need? What do you think about that logic?
Thinking of the existing round as the last round?
Yeah, let's say I'm raising the seed fund, but I'm always keeping in my head that I'm hoping that this will be the last round that I need to actually to have, and I don't want any more rounds. So
yeah,
because
no, you don't want. It's one story, but whether you would need it's a different. Listen, I would quickly respond in that manner. I don't think it is productive to think that way, because once again, and we'll come back to that, David, that depending on your business model, you most likely, if you're really ambitious and scalable, one round most likely won't be enough just to expand. It's not building a product. You most likely will start bleeding the cash the very moment you hit the market, which may sound counterintuitive to some of us, but depending on the business model. So I would say, I would not, if it's okay for you, I would just say I have no opinion on that. It's a matter of tactics. And largely a strategy as well, but it's a matter of tactics. I think I would probably turn it around. I would say that if you're really ambitious, I would really, in my fundraising, plan for the next round. And then I will be positively surprised if it's not needed. Okay?
Yeah, well, I actually want to challenge you with that, because from founder's perspective, you want as many shares as you can, and I really do believe that AI will allow you to not raise that many rounds. It's really
okay. Let's see. Let's talk in 5 years now.
Yeah, let's do that.
Perfect. Thank you, guys. All right, let's take. I like round numbers, as you know. Let's take 13 minutes, quarter to noontime, okay? We're back 11:45, and then I'll try to stop us. All right, guys, we're back, I think, and hopefully Give me a sign that you hear me. Is it? Yeah.
A sign.
Sign. Okay, good. From the other side. Thank you. Thank you, Elvi. Let's move on. So we have not that much time left because I also would like to finish at time because on time because I have a few things at 1 o'clock. So, all right, but still, the second part, the first part, we spoke about the landscape and how it's probably transforming. And now let's talk about a little bit about vocabulary and practicalities of fundraising. And there already were a few questions that I've in a break that I somehow try to touch upon and answer now. Okay. Yeah, and people are coming back, so it's all good. Now let's start. Let's start unveiling some things. Just to let me know. Okay, works now. Okay. So, okay, something has broken, of course, in my, but okay, I'll fix it. Anyways, so funding. Most of the things we spent talking about is equity investment. The two types of equity investment possible technically, one is so-called priced round, and one is convertible note, loan or convertible note or whatever. Okay, so the priced round is a very typical situation where you agree with your investor that, okay, you'll issue that many of new shares. Remember, new shares, because the change of hands shares, that money will end up in your pocket, not the company, right? You issue that many of new shares, and they are going to buy those shares for X amount of money, which is that investment thing. And then, which implies that the valuation is set at the very moment you agree, for example, that they will give you 200,000 and or own 10% of the company after, just for simplicity, 10% of the company after this issue was closed. Will be closed. And a convertible loan is basically, this is a one tiny little exception. You convert, and we'll talk about that later in a bit more detail. And they're very controversial sort of views on that. I'm the one who likes it, which I think it could be helpful occasionally, but that is basically a equity with postponed valuation. So basically, it's supposed to be converted. This is a loan first, which is supposed to be converted into the shares, but at some later point, at some other trigger. So you basically you skip the discussion of what's the percentage for what, AKA you're not valuating your company at the time of investment, but it is supposed, if things don't go wrong, it is supposed to convert. Okay, it's not, exception would be the situation when it's not converted. It's kind of supposed to be converted. Okay, those are two. Sometimes you need, and you can also intuitively deduct what are those situations where you would like to postpone the valuation. Okay, then there's the revenue-based funding, like I said, which can take forms of loans or investments, which is basically earn-outs. You could slowly repay from your cash flows. Then there's this beast called mezzanine loan, and sometimes the revenue-based loan is also has a feature. A mezzanine loan or a quasi-equity was it has been not that popular with the startup community and with funding startups. It's more popular, like historical popularity. It's more into real estate, for example, projects or something, or greenfield projects like wind parks or something, where you can't fund everything with a loan, with a kind of senior loan, and the mezzanine means that this is a loan eventually with a variable interest. So there are two parts of the interest you're agreeing upon. One is fixed, which could be even probably a bit lower than altogether, right? You can have you pay like fixed loan plus percentage of your revenue as a loan, as an interest, pardon. Which means that in the year you're doing better, you're paying bigger interest. In the year you're doing worse, you're paying worse interest, small interest, pardon. So meaning it's kind of a little bit has the 10 logics of the investment where your lenders are linked to your success, because in a classical loan, of course, to the fixed or even a variable interest rate, but this is varies on from the market rate, right? This is not the case. Here and this is why it's called quasi-equity. This sits something between equity and lending. It has gained popularity also recently in the startup world, maybe because exactly of the thing that sometimes you are already late in a game and there's no point of raising, but still, you know, your funding parties would like to have some upside with you. Okay. Like I said, that's not that popular for startups in particular. Then there is a non-collateral loan, or as in English terms referred as junior loans, meaning they're subordinated to the senior. That's the entire logics, which are those overdrafts and credit card loans and whatnot, also for the company and some other instruments, where basically the difference between the senior and junior loans is that you're not required to give any pledge. Okay, or you are giving an illiquid pledge, the pledge which has a very poor liquidity. For example, pledging your company shares. Your company shares are worth nothing if things turn bad, right? Again, emotionally, of course, beware of kind of raiderism and whatnot. But if putting those things apart, I have no problem with pledging my company shares as a collateral, because if I'm doing good, I will be repaying loan. If the company will be doing bad, they're worth nothing anyways. But this is so company shares is not. This could be like regarded emotionally hard to pledge them, right? But these are not those shares don't have liquidity as opposed to, you know, fixed assets and buildings, machinery, house. Yeah.
But that's also a risk to become a minor owner of the company. So if you get such a loan with your equity, for example, big equity, but you, of course, thinking positive and you plan to give back, but at some moment, okay, you just can't give it back, but company still works. If you don't back it, then you lose the majority.
Not the majority, you lose everything, because no one takes half of your shares as a pledge.
Okay, well, all right.
No, you're losing majority in diluting with new investment rounds. That's a different story. But if in a pledging, you're basically, that's very binary. But again, let's be realistic. It's unless, you know, that lender has not a bad intent in doing that. It's I would say this is kind of more of their protection against their will, you know, you'll be doing good and not repaying the loan. I see what you're saying, but once again, I said I have never had a problem with that, provided because the lenders, the same as with investors. I'm just sidetracking myself. Financial investors, strategic is different, but financial investors always will look for minority, because they do not want to run your company. That's the big idea. They want you to be busy with everyday things, not like selling, like they take 51% of your company and then you go like, oh, fine, now you run. I am just 49% minority owner. I'm super happy now. I'm just showing up on shareholders meetings, of course, keeping an eye on you and auditing you, but you run a company. And normally any financial investor, which we were to be talking about, would never want that, unless they believe that you are not able of running it and they have to, you know, change remember the Jobs was kicked out of Apple at one point and everything. That's a different story. And Musk seems to be getting kicked out of Tesla very soon. Yeah, so this is the idea. But yeah, okay, then there is, so juniors, seniors, the difference is that the senior loans are lower, cheaper money, lower rates, but they require pledging of liquid assets or guarantees. And this brings us back to the discussion, how much you want to expose as a private individual. Yes, no. If no, fine. Yes. Good luck with that. Okay. Then there is a soft loan. Actually, there was a very popular program here in this country many years, like 10 years ago, I would say, which was quite, I think, useful. I wouldn't say it was successful, but it was useful. The idea is this, and I'm actually a big fan, for example, for soft loans in as opposed to grants. But this is my personal subjective take. I don't like grants because I think they are developing in general. They are very useful. I'm not denying money is money, but I think often grants, because of the particularly European grants with the huge bureaucracy behind it, it's not always in the case. For example, in some other parts of the world, I've seen the grants are not that bureaucratic, but it is what it is. And the problem with the grants is that they cultivate a bit different mindset that you would like to have in your startup, because you are eventually forced to develop some competence in paperwork rather than in building product. Because, and that's a huge debate we can go on, and maybe not for today, but I would always say that the grants are not like a free money. Sometimes those invisible strings attached are very, very painful, because sometimes you have to really live a double life. Because if you promised within, because the grant was supposed to, you're doing slightly different, and this the worst thing is slightly different thing, and you have to depart strategically from what you would be doing without the grant, you're in trouble. It's in my world, it's not if, it's when this forking will kick back, because you are developing, indeed, doing lots of things, ideally just on a paper, but sometimes also supposed to do in life, which was required by the grant rules, but is not exactly strategic to what you would be doing without it. You're living like a double life. In Old Greek, it's called schizophrenia. Yeah? I'm not sure if you want to get there, like parting of your personality. Okay, but so why I told that? Because soft loans is, I mean, in my world, a better version of just giving out the grant. So what is a soft loan? Soft loan is a loan, sometimes of relatively preferential terms, but let's not discuss the interest and anything. That's even technical. Which is given to you as a loan, mostly very early for starting up, pre-seed and stuff, not later. And then, as opposed to grant convertible loans, where we spoke with Jits, right? The grant convertible loans, which is the next in my bullets, is the other way around. If you do well, they will basically write off part of the principal. But the soft loan is the other way around. If you're going bankrupt, if you're closing down, they write off it. It becomes the grant write-off at the moment when you're doing bad. If you're doing good, what's wrong with repaying that? That was just an ignition money, right? You can probably, again, refinancing is not easy, but you can try to pay it back from your kind of early revenue streams and everything. So it is kind of a grant if you're busted, but it's still a loan if you're doing well. The beauty is accountability in my world. Beauty is that you're happy to pay back, and then also whatever the grant, this soft loan awarding institution, which are public institutions normally, are happy for some of you getting, this is like also a portfolio thing. Some will go bust, some will repay with a little interest or big, whatever's there. I'm typically not a big interest. And that works well. That gives you the first like a startup money, starting up money that is even probably not a pre-seed or early pre-seed or something like that. I like it. It was around here for 3 years or so. It's not anymore here for a variety of reasons, because now we have those investment funds and everybody. But I kind of think it's not a bad idea. For example, for deep tech startups, because deep tech startups are so long in development cycles and so far away from market most of the times, that none, even a subsidized, leveraged pre-seed funds would touch upon them with a barge pole. And you need to get somewhere. You need to have some proof, and often the deep tech is also expensive. No matter what the agents tell us, there are lots of things which you have to do on a kind of technological level. I like it. Grant convertibles we discussed with Geertz. It's like also a public thing that if a loan turns into a grant, or part of the loan turns into a grant, if you're ticking the boxes. Very much a paperwork thing, but still they may have also KPIs which are relevant. Grants and subsidies. I was not putting them on my ugly map, but obviously they can come in all shapes and sizes, very themed, regional, whatnot. I already answered what I think of them. I would say, do take the grant if that doesn't distract you from your strategic course. What's wrong? I have this cynical saying that the grants is nothing else than German and French taxpayers' money in your equity. What's wrong with that? I like it. I like money, generally speaking, and it's why not, right? But be very careful thinking of this as some like free lunch. It's sometimes very expensive lunch. Sometimes you're just losing the focus, losing the track, the pace, the path to your things you really need to do. Okay, so treat it with caution always. If you would be doing this thing exactly as they are happy to give you money, take the bloody money, provided that that's, of course, it's not super bureaucratic and you maybe can outsource the bureaucracy. I have nothing against the money, but be careful. Most of the times I've seen it has some small print in there which can backfire. Okay, and then there's alternative funding sources. We can think of reward-based crowdfunding as part of raising funding, but I think I told that two months ago that I more would invite you to think this as a validation, as a customer, like your solution test, rather than raising money. Better have the money to build it anything, but just test it like a crowdfunded, pre-sale, or whatever, whether it's sticky. But this is, again, remember, this is physical products, item sale. This is the sweet spot for crowdfunding. And then there was 10 years, it was a big, years ago, it was a big thing. Now it's less a thing, but all sorts of initial coin offerings and ownership auctions, like tokenizations and all that stuff. Again, my point is that, yeah, if it's really makes sense in your business model, why not? But most of the things I've seen like 10 years ago when it was a hype was like, again, done because it was a hype. There was no intrinsic logics of the business model of some token sales, token offerings, or initial coin offerings. Most of that was made up. I've seen some business models where it's kind of logical way to fund things. Yeah.
Yeah. The question: is there a case that person needs to pay back a grant if something doesn't work as planned?
Definitely there. That's a question. Okay, is there a case that someone is struck by lightning twice? Of course, there are cases in the world. Yeah, of course, but this is only because of the, again, you need to read the grant rules. The question was: is someone is forced back paying forced paying back the grant? Yes. Yes. But then you have to really misbehave. You really have to break some rules in there. And this is largely also very formal things they require. For example, they find out that you have used the grant proceeds for different things, or you haven't done this. I haven't seen, I trust the answer, those things. I've never have seen in my life that the grant is not like requested back if you're not meeting certain like KPIs, which you can't bend. Sometimes you're not meeting them, but you can still play out you met them, right? But I haven't seen any of those.
In some European like fund, yeah.
Yep.
Like I don't know, 5-7 years ago, the main goal was that you just spend your money on your goal. It was enough.
Yeah.
If you did it,
most.
If you don't stole it.
Yeah, most
but
of.
Later on, they added some points.
Yeah, the KPIs.
If you don't meet your goals,
yep.
They can ask you to give it back. So then are not so ultra positive with your goals anymore.
Yeah.
Because before you were promising like millions only to give you money, but when they added this point, okay.
Yeah, you're so right, but there's also some disclaimer to that. First of all, most of the grants, unless they're super small, most of the grants, they have duration over time, and you can renegotiate your goals. If you see you're not meeting them, they're quite happy. They're also not happy to start the procedures of requesting money back. So they are kind of happy to renegotiate the goals because you have an upper hand there. You already have the money, but okay, how about that? But this is, yeah, once again, the simple answer is yes, but the more kind of elaborate answer is most of those goals are relatively formal and relatively process oriented rather than result oriented. Some are result oriented, and that's fine. Yeah, so be careful what you're promising. That's probably the lesson out of all this. Be careful with whatever promises you're making. And sometimes, most of times, you can renegotiate them. Okay, now we go into the thing we already discussed in the lunch break with some of you. That was about types of funding. Again, most typical ones. There are a couple of variations thereof. Now let's talk about the stage. It sometimes has been understood very mistakenly that these all the pre-seed, seeds, and lettered rounds like ABC, they are a function of investment size. That's wrong. Okay, you can have a later stage round of 1 million and a pre-seed round of, I don't know, 30 million if you're building a competition to SpaceX, right, for example, because there's nothing less to start with than a couple of tens of millions as just your pre-seed. You're just building your prototypes or whatever, proof of concept. Okay, so which is also has a little, this one also has a little taste of how to think about what the investors are looking for. Pre-seed round is everything which is your pre-market, pre-revenue. You basically are spending the money of building on some sort of prototype, proof of concept, first pilot, whatever you call it, at your thing. But you basically are pre-revenue and you're building something that could be launched or tested. If, for example, in a deep tech, it's just really bringing maybe a few TRLs up, and that's what it is. Now, you are raising for, so what you're supposed to do with the money, in very generically, I'm generalizing to have all the potential scenarios in. So you're raising for initial validation of product market fit hypothesis. You basically want to throw something against the market and see whether it sticks or not, and then iterate accordingly. So, and this is pretty much also includes building some first prototypes, MVPs, minimal viable products, minimal commercializable products, whatever you call those fancy things, right? This is what you don't have revenues, you have kind of a idea, seems that it's going to work, and then you have to get it to the market. This is the pre-seed round. And you are basically, as for fundraising purposes, you're selling the dream. And remember this, if there's ambitious investors, you sell the opportunity size. If they're portfolio builders, if they're more cherry pickers, you sell the return on investment. This is great, no risks, invest in me, and yada, yada. This is you're selling the dream, and you're selling that you're the A team that's going to deliver. Because you don't have much there. You even don't have a proper product / prototype. So you're selling the dream. You're saying, okay, we'll be, if we make it, we don't know, but if we make it, we'll be unicorn kind of story, or we'll return you 20% per annum over, I don't know, those X's. Depends on the investor. So this is a pre-seed round. Now the seed round, or the seed plus round, sometimes also referred to, depends if it happens shortly before your market launch or shortly after, it doesn't matter. Let's call it seed round. Seed round is the round which you raise around your launch, maybe a bit before to go on a market, or maybe a bit after to, you know, make sure you're properly there. So you raise for, again, better validation of your product market fit. So basically for the stickiness, for recurring customers and everything. And you still sell the dream because maybe you have initial revenues, which is nice. And again, if you look on this scalability thing, the more upper you are, the less you're required having revenues for the seed. The lower you are, the more you're required to already have some paying customers. But this is like a maybe not relevant distinction, right? So you're selling dream and you're still selling a team, but you might be also required starting to discussing some already, I call it scaling strategy. It's very vague. It's kind of assumption that this will be, you know, this is the business model we can scale up, and this is, you know, our acquisition cost and what. This is still on paper, but you already most likely need to have a discussion on that. Whereas in a pre-seed, it's just give us money, we're a pretty thing, right? We're a super cool team. We'll conquer the universe. Again, I'm overgeneralizing, but this is how the story moves. And this is kind of important if you raise. Where you're climaxing with your storytelling, with your pitching and everything. What is the thing you want to convey them? Okay, good. That was around the market, meeting the market. And then there is the next rounds are for expansion. And they are called like that: A, B, C, D, E, F. F stands for failure. No. Anyways, and there we were back actually to discussion we had with earlier with David. That C for catastrophe. Catastrophe. Is it what is that? But okay, good. You're following me closely. I know. Thank you. Yeah. So the basic idea is that you have already some market position, entered the market, repeating customers, and then you are raising for expanding of an already existing, or at least to an extent proven business model, maybe internationalization, bigger markets. And then and that is the biggest difference maybe in terms of the storytelling. You don't sell that much of it. You still, of course, have to, for new investors to provide the proof that you can grow big, but you're more of, then it starts, you know, the number crunching part, which is not that big actually initially. It's more about the feeling whether you will make it and whether it's worth doing it, right? Here is the number crunching. Already you're required discussing all the projected cash flows and how maybe is the acquisition cost changing with your next 10,000 customers or not, and why you believe you can scale it so efficiently, those numbers up and all that story. And that is largely a reason why relatively many raise seed and pre-seed and relatively few raise lettered rounds. Now, a word on the question we had, or little debate we had with David on the matter of how many rounds are supposed to raise or not supposed to raise. Yes, I believe that. Democratizing of the development and market entry by AI agents and similar would change the game. However, I would say that this is also not only the matter of your cost at developing a product, but there is also the very biggest for the lettered rounds, for the later stage rounds, that even more the cost of acquiring your market, acquiring your customers starts playing the role. And I'll explain you with it super simple. Again, that also is going to change. I don't know exactly how. With a very, very simple example of, let's say, a subscription business model. Okay. So you are selling as a recurring revenue, as a subscription, you're selling some sort of I don't know, B2B software for 100 euros a month subscription, okay? And then there is an average, because of the churn and everything happening, and I think you have discussed it with smart people here, you end up in kind of an average calculation that the average customer stays with you for 2 years, right? It's 24 months. 24 months 10 times 100 is 2,400 euros, 2.4 thousand euros. And then you, again, from your example, initial experience, you already are gathering, are seeing that on average, to get one customer costs you 500 euros. It's kind of not a bad thing, 5 to 2.4 customer acquisition cost with all the, you know, outreach, direct marketing, content, everything. It's about 500 euros. And now imagine that you're basically, if you have figured this out, then in principle, again, we simplify the rule that if it is, you know, if you can keep this equation, then the more 500s you spend, the more 2.4s you get. But this is extended in time. So you're recovering your expenditure only in the month 6, right? So which means the faster you grow, the more cash you bleed. Simple. Again, I'm simplifying on a purpose. There are lots of buts in that equation. However, that is the justification why sometimes you need to raise those A, B, and C's in order to get to world domination, if that is the ambition. You can grow organically, fine. I'm not saying anything, but if you have figured out that by giving 5 in, you get 24 out, many of us will be very tempted to have more 5ers, right? That's the idea. That is the idea of fundraising in the later stage. And the line is very fine. Sometimes, you know, with all these Uber, you know, stories and everything, if they raise those A and F rounds, it is debatable whether they're just growing fast or whether this is already an imminent failure. It's not necessarily from outside. Okay, the management maybe knows, but from outside it's not that clear. Even looking at books of them, it's not that clear whether it's just a fast growth, bleeding, cash bleeding, or is it already something crooked in the business model per se? Okay, so this is the idea why I think multiple fundraising will still exist. Discussion is, of course, of the runways, of timings, how much it lasts, of all the sorts, how you can also automate that part of acquisition. I get it. I'm not saying it will stay as is, but I'm just saying that sometimes this is for many of us, and the same is with platform businesses, right? Ubers and Bolts and whatnot. And Bolt has, they're very different. Uber has very expensively, and Bolt is growing relatively. Everything's relatively organically, and not bleeding that much of cash, but still raising a few rounds now and then, once in 2 years. The idea is that it is, and it might sound counterintuitive, right, to some of us. Okay, we're breaking even. Yeah, now the cash is piling in. Wait. If maybe some others, you have a risk if you go for big segment world domination, you have a risk that someone will outrun you who raises those 5ers into the acquisition. Ta-da! So this is not that an easy of equation. Okay, got it. Move on. A note on a note. Okay, what is tautological? A word on convertible notes. I promised it. I'm just looking carefully because I have to still finish in time. So convertible loans or C notes, as in the UK, or SAFE, which is a specific, not exactly all convertible loans should be regarded as SAFE, but this is abbreviation of Y Combinator actually invention, abbreviation for a simple agreement on future equity. So basically we're giving you money and agreeing on having equity later. The basic concept is this. There are nuances and variations, but the basic concept is this. You're very early, you're pre-seed, for example. And the earlier you are, the more pre-money you are, the more that your hockey stick, how fast you'll be growing and what the revenues will be growing, is more of a philosophical debate. It doesn't have, you know, any ground. Okay? If you already have, if you raise A, B round, you don't need this because you can play with numbers and get to some agreement easier. If you are early, you sometimes don't have this you like the investor, investor likes you, but the only missing thing is that you have, and not necessarily you are right or them are right, but you have this discussion, what is the growth potential, hence what's the valuation, because the valuation basically is the discounted value of you in some future time. Now, and then sometimes it's not useful to spend like months in discussing your valuation or whether the hockey stick is so steep or so steep or so steep. You can go, okay, you give us 200K or 100K, right, as a pre-seed to build this and to get into the market. And we are just taking this in as a loan, which is going to be converted into the shares at the next fundraising round. And the external investor, the third-party investor, will determine the value, because we already eventually are in the market and have some metrics to be more or less thought about. And we just, okay, they will, for example, pay 100 euros for a share, and you will be having, you know, paying 50 euros for a share because you came earlier. We convert at that rate. It looks like difficult, but it's super easy mathematically. So you basically take in the money with a promise that will be converted into shares later at the next investment round, which is valued by another investor. So two things. First, it is implied that this is not the last round. There should be another. It could be other triggers like a beta or whatever, but this is crap because you always will be able a little bit to bend it, and the investors don't like it. They want third-party evaluation of the investment. And you pay a very symbolic interest, and you define term. You have to raise not less than that amount of money, not later than that, in order that to be this promise to be enforced. Discount, what I said is that discount towards the value of the next round's share value, and then of caps and floors. Floor is that if it's a forced conversion, if you, for example, haven't raised at least of an amount in at least of what a time, then the investor can ask for forced conversion at the worst terms that it would be initially. And the value cap is the thing that also sometimes if you, for example, are doing super good, too good to be true, that the cap sets that the minimum amount of shares, even if without this discount and mathematics, what the investor gets. So not less than 2% or whatever valuation you raise next. Okay, so pre-seed and seed works, especially the pre-seed, where it's difficult to evaluate the company, and you need to have the next investment round to have in a picture. And I would say if it's structured right, it provides a win-win. It's not only in companies' interests, it's also in investors' interests, because investors should also not, sorry for my French, bend you over, because it will heavily diminish your investability later. If they will buy in cheap, then it's difficult for in the 1.5, 2 years raise at a much bigger valuation. So the next investors get suspicious. What was that, right? So it's sometimes a very good thing to think. Some investors hate it, never do it. We will be having Anders Berzinch in the panel. Change never does convertibles. They have their own logics and the explanation. Ask him. But I think for sometimes when this is the only bottleneck is the valuation works well. Okay, now some terms. Valuation. So valuation is the value of your company, and it has two. For those of you who like mathematics, no, who don't like, because who like it instinctively, you get it. But for those of you who maybe not like mathematics that much, there are two types of valuations: a pre-investment and post-investment. And my invitation is always to keep all parties and all discussions on an equal ground. Always discuss your pre-investment valuation. So in other terms, how much your company is worth before you issue the new shares and get the money. What's the difference? For example, okay, let's play this a little bit. You are giving, for simplicity, you're giving 10% for the 100,000 of investment. 10% of 100,000. What is your pre-money or pre-investment value of the company?
Really?
No. That's post. 900, because 900 the value plus 100 of money makes million, out of which 100 is 10%. Why is that important? Because if you would think of raising 200, it won't be 20%. It would be 200 out of 1.1 million on the same terms, which is what it is. Yeah, less than that. Okay, and it's roughly 19% or something. Okay, that's the basic idea. So again, you can forget it, but in order to keep things on the same page, I highly suggest that you're thinking in fundraising strategy of your pre-investment valuation. Okay, ordinary versus preferred shares. Preferred shares is super rarely used in early stage investments. Later rounds, yes. The preferred shares, the shares that don't give you voting rights, but give you so the first-hand rights on some profits, and sometimes the ordinary versus preferred shares is the way you deal with later stage investors, where you are okay giving away some preferred their preferred position on earning something by trading in the voting rights, right? Because as a founder team, you want to keep more voting rights that you have per percentages. Maybe you have, like was classical was this WeWork, Adam Newman. He had the famous scammer or successful person, depends how you look at that. He had, I think, back in when the WeWork went bankrupt, he had only some 20% of shareholdings, but hold 50 plus 1% of voting rights, which made him like play against his investors. Dilutable, non-dilutable shares. Again, very rarely non-dilutable shares are. I would say you should avoid giving non-dilutable shares. The non-dilutable share is that it doesn't diminish even with your not investing. It does not diminish percentage-wise. You disproportionately distribute the other shareholders, but that one keeps the share. The only thing where I have seen the use of non-dilutable shares is in deep techs, where the universities take some small fraction of the shares, and then those are non-dilutable, like 3%, 5%, something. I would personally be very much against giving university shares. That's a different story. But if they take shares, then probably the non-dilutability clauses may apply. Sometimes the non-dilutability clauses are asked by early stage investors like angels, but mostly they stem from the idea, from the discrepancy. Sometimes you promise that this is the last round, right? And they invest on that premise, and then you need to raise another 10 mil. And then I come back and say, hey, something went wrong. How about exercising some but this should be, of course, set in the first place in the papers, the non-dilutability. Down rounds. What is down round? Down round is technically a definition of raising the next round on the pre-investment value lower than the previous post-investment. So you are lost, the company has lost the value between the rounds. So the next investor buys in cheaper than the previous ones. This is called down round. This is probably one of the things, again, sometimes not all, even huge exits and great successes have had down rounds. It's up and down. It's not like in a book, like always more valuable, more valuable. And then that could be sometimes the non-dilutability can play in if you raise the down round. So you actually somehow match with promise your earlier investors that at least they will be kind of matched with that. But I would say, no, I try avoiding non-dilutability. Tranching, this was the question you were asking, right, about this. And this is this is not like having an agreement that in the next round you will participate. But this is in the discussion of sometimes you don't need all the money immediately, right? And you have this agreement that, okay, we'll give you half the money now and half the money in half a year or something. Just, I mean, physically. This is called tranching. My experience is very negative with tranching. I would say never ever tranche anything below like 200 or $250,000. Yeah, indeed, if you raise 2 million round, that you might not need everything at once. But be careful with the tranching, because the tranching, if it's just a passive, if you ask for the money and they give, fine. But sometimes you inexperienced founders agree upon certain KPIs. And I have the worst, I was an advisor to the team. And I felt also bad because of that. But there was this in Latvian, this is a long story. There was a hardware startup. They raised 150 mil, for God's sake, 150,000 of pre-seed. In order to basically, they had already one market-ready product and were building the other, and they were silly enough, and I overlooked that. I would never agree to that, but for some reason they never showed me the terms, and there was an agreement that, okay, we give you like half of it, like roughly 70K now. This is a tiny amount, right? And then in 9 or 10 months time, we give you the other, provided you meet those things. And in the meantime, they pivoted and they focused only the second product. The first was obsolete, but they were promising some KPIs on reaching the milestones at both, right? But you still don't know where it's the sweet spot. You're still iterating. And it ended up with a very nasty way, because that was a very unexperienced first-time founder, the CEO. And he, in between those times, he was actually got on on a personal level, he was like very much disliked by the investors. And then when this next tranche came, like the other 80 or whatever, roughly the half came to be asked. He sent, because the second product was doing well, the first was not there, and he came and said, hey, we need now 80. And the guys, because there was a small investment, and maybe there's also were inexperienced fund it was though, and they were probably, that was just out of revenge to punish and to show the other portfolio teams that it's not the way to do it. They said, okay, let's revisit the KPIs. Okay, this is matched, this is matched, this is not matched, sorry. No, just sell those items. It was a super luxury product. Sell those 5 items worldwide, you promised, and you will get it. But he said, come on, we're doing so 3 times better with the other one. No, read the document. And they didn't follow. And that's my idea is never ever tranche any. For bigger, you can discuss, but never do that one, because, or do it super passively. If you ask, they give. No KPIs in the meantime, because the KPIs will change most likely early on. We'll go in a different direction. And the pro rata is the big thing. Always give it. This is the way the early stage investors make money. And the pro rata means that if you raise the next round, the investors from the previous round can keep the percentage by investing proportionally more, keep their percentage, not being diluted, but not just non-dilutably, but pay in the money at the valuation which the next provides. They're kind of like dragging along with that one in order just to, because if some third-party investor invests in you, most likely you are doing not that bad. Most likely they will like to double down on that startup. They invested in a pre-seed, for example, an accelerator or something. That's a big idea. Always should be given, fine. They have to pay in real money at the same valuation, not beneficial terms as the next round, to keep their percentage. Because of course, if they see that you're doing good, they want to increase the stake by not losing the percentage.
About tranching, the question was, well, for example, I understand that I need 500K for a year, right? I need also like safetiness for next year as well. So in this case, if I don't guarantee the money for next year, I need to think about next round already in a half of a year, like from the logic. Like I thought that how can I
you don't raise. Okay, the first thing we'll talk about that, but the first comment, you don't raise for years, you raise for milestones. That's a big idea. The milestone can come in 12 months and 18 months, the next one. And think always about the runway to milestone in terms of fundraising. You have to reach something that is different from now. That's the idea. Not like a year and then, wow, what's happening? You have to say, okay, we need to get, now I need to raise the money to complete our prototype and get, first 3 paying pilots with enterprise customers. I'm making it up. don't know what you're doing that much. And that's it. And you calculate it backwards from then. Okay, I might need like 15 months, which means let's make it extended to 18th because things take or 2 years because things take longer as we expect, right? And our burn rate is this, and that's how I'll get a little bit to how to, in a broader sense, that was also your question, how to calculate the things. But this is the idea. You never raise you raise for a milestone, because the worst thing you can have, you can raise for something and you can't reach. You spend the money, spend it wisely, but you don't have a differentiator, right? Something achieved, and then you're actually dead, because no one. I'm visualizing always. It's like going into the desert with your I don't know, Land Rover and being out of gas, and then no one runs after you and pours the gas. You just rot there. You have to go to the other side. That's the entire logic of fundraising, whatever is the need and whatever is the other side. Okay, more terms. Exit conditions. Now let's talk exits. That's lucky, funny, great exits. Liquidation preferences we already discussed. This is your investors' requirement of recovering some, like a first-hand rights on recovering of some funds, typically the investment amount. Multiple X's is very unhygienically. Remember my story with how everyone takes their preferences and founders get nothing, just the fame. But basically that is something, again, you can look again, it's a supply and demand thing. And I think back again to our discussion earlier, maybe if the supply is bigger in venture capital than the demand, then you can probably try to get rid of liquidation preferences. Why not? The later investors are, the more they are asking for. This is also counterintuitive, but the VC rounders are asking more for liquidation preferences than angels. There is a certain reason for that. But okay, now tag-alongs and drag-alongs. This is a big thing, and both should be given and asked. So tag-along is the investor's rights to sell along. So imagine the investors invested in you and they have 30% of the company. And now, this some of your competition comes and says, okay, we're happy to buy your company for 100 million, but we don't need all of them. We just we need the controlling stake. Sell us out your 70 and we'll fine. And the investors go like, no, either we all sell or we sell in proportion. If it's 70, then let's split. Okay, both. Let's keep that minority shareholdings, but we basically sell in proportion. Whatever they're offering you to buy, we're selling in proportion, because they weren't. Simply speaking, they went in bed with you, and they don't want to wake up next morning with a Shenzhen factory number 63, right? That's not exactly what they want, and that's fine, and that should be given. Okay, so either the investors can tag along you and sell on a proportion, or then it's normally goes back to discussion selling all the 100%. Drag along is the other way around. that, for example, you come to your investors and say, yeah, Apple is buying us for $1 billion. And investors go, let's look at my Excel. No, we want a bigger multiple out of you. No. But of course, Apple wants 100% of nothing or nothing, right? No, we're vetoing, we're blocking the sale with our 30. We're not selling 30. Apple's not interested in those 70. We think Google will come next year and buy us for $1.5 billion. And you say no. We'll prove you to this is an arm's length deal. Of course, they have the right to make sure that you're not getting, paid extra somewhere else than in the transaction. That's a legal part. But basically, you as a majority or the bunch of majorities can exercise the drag along. It's like, no. That's a deal. It's an arm's length deal. It's not a crook deal. No. We're not getting more than you per share, whatnot. But we're selling because that's majority's decision or whatever is majority or whatever is playing. This is called drag along. So both should be given and taken. This is more of an issue of the Silicon Valley, the latter one, than the investors are really obstructing the deals, which look kind of on a surface like very decent ones. Okay.
So which of them is granting veto rights, even if
no, if you don't have drag alongs, then they can say that if you have a buyer who needs 100% of shares, that you need everybody to be in agreement to sell the shares. And if for example, minority, typically the financial investors are per se, each of them is in a minority. Some of them is saying that no, for some reason we believe that we're worth more than that. That if you have the drag along, you can say no. If majority votes that we're selling, we're forced to sell you on the same. Again, they have the right to make sure legally that you're not playing games. For example, sell it for €1 and then have another value and then sell some, I don't know, IP for $1 million on your own. That's a different story. That's of course is obviously their fear is that this is not an arm's length deal, and eventually you're having, as others are having, some other concessions, some other benefits that the investors are having. And you should be giving them the right to make sure that this is not the case. But other than that, drag along is kind of force dragging them along to sell everything if someone buys either the 100 or nothing, right? Which would be the case with a strategic acquisition.
What's the idea there? Like some company would want to buy the team just for the team?
No, they're different. They're different reasons.
Great compensation. And buy them for pennies, or?
No. This is sometimes, yeah, exactly. Sometimes you also, if you have this arrangement and you're selling because I don't know, the team is out of motivation to work, and there are lots of other things. The main thing is that you are making you're building it in a way that your investors can't obstruct the deal. And there are many reasons why you would be no. Sometimes it's exactly if this is a portfolio investor, like portfolio builder expecting 10x, and you're selling for something that gives them 5x, that they would assume that okay, let's wait for 1 more year, and you will be more like valuable, and someone else will buy you. It's just aligning. There are lots of reasons why, in theory. There are lots of reasons why the investor would be not happy selling. But if everyone else, if they're a minority, then the drag along force they can actually this is a bit more complicated than that in a real life. They can actually also pass on those rights. If, for example, if the buyer is still fine with 70, they said, no, we're not exercising our rights. We're happy to stay. That's fine, but they can't block the sale of the 70. Again, this is very, very improbable that they will going to stay, but the reasons could be there's not only the acqui-hire, like you mentioned, the acquiring the company just for the team. Okay, syndication is the joint investment of several angels. Typically, they make you don't have 5 investors, they all get together in so-called in SPV or special purpose vehicle, it's called, and invest as one entity if they're. Remember, I spoke about the angels that they also want to sort of distribute, sort of diversify their funds into, maybe I have 100,000 euros to invest a year, but I'm happily teaming up with other 4 to invest 20,000 euros in 5 companies, like 100,000 euro pre-seed investments in the companies. Okay, different same time valuations, never try avoiding them as much as possible. Sometimes when your fundraising round goes so long that you actually sometimes are in negotiation process, you promise, you know, different valuations to different investors the same round. Never do it. They will find out sooner or later. That's a no-no. Exclusivity provisions on term sheet, which means that if they send you the first proposal term sheet, some of them are really asking for, you're not supposed to talk to other investors while we are doing the diligence or something. Try avoiding that, or try to make it very, very, very short. Because sometimes and I've seen very sad cases where they ask for exclusivity, so you're not talking to any investors while we're thinking, and they think for half a year, and then what? I mean, who's suffering? Companies suffering, and then they say no in that, because if you do the exclusivity provision, they believe that now they have the upper hand in the valuation discussion and everything. So don't do this as well. Okay, a few last things. I think we have to also have some 15 minutes or so. Oh, only 11. Okay, so yeah, vesting, reverse vesting conditions should be discussed. I think we spoke about that earlier. So basically the idea is that the founders also sometimes are vested, or technically speaking, reverse vested, that they have the ownership of their shares only at a set time, not in the beginning, the full ownership of the shares. Otherwise, they're agreed to give it back to the company. It should be all things cleared off the cap table, and the option pools. Good investors will always, at the seed stage latest, require that you have set some option pools aside if you haven't done it before. So some percentage of motivating the future key employees. This is okay. In good quality investors most likely will be pro it, not against it. It's fine. It's of course at your expense. This doesn't impact the valuation, but still. More the later stage, more the truthful that is, that they will require some board seats, but the later stage rather than the early stage. Some are requiring it always. Again, look for, some are not. At least in Latvian commercial code, it's not very wise requiring a board seat, which is valdes loceklis, because they are responsible jointly, and no legit investor would like to be responsible for whatever he's not running or she's not running every day. The supervisory board padome is more a possibility they will ask, but then you have to form it, which is not necessarily a bad idea, having padome. And the veto rights, this is more common that in initial stages, they have veto rights on certain decisions. For example, any purchases over 50K solo, like a capex, should be run past your investor. I guess it's kind of ok. You have a good reason to explain why you need it. Not 5K, that's silly, that's macromanaging. Avoid those guys. Okay, practicalities, the last part from my side. How you prepare. So you agree of amount, and now we're back to how to think about the amounts. You have a burn rate, which means what you're spending every month, and what you project spending every month. Then you have the length of the runway until the next significant milestone, which would be able to help you to prove things and raise eventually at a higher valuation the next round. Okay, you have like for example, 10K of the burn rate per month, and you look like you need about 15 months to get there, to launch the product, for example. So it's 150K, plus maybe there is one like server purchase as it used to be, or maybe some other one-off type of CapEx, add to that. And then the next thing is, of course, add some slack, because not necessarily if you think that the 200,000 will last you for 12, 15 months, most likely plan for longer, plan for a bit more expensive things. Maybe you will end up from 200 into 300,000 or something like that. For the preparations, think if there is a critical know-how that is somehow sits in just one of your heads, because investors are super, super reluctant in investing in something that doesn't, if, for example, even IP, but not only IP, sometimes even know-how. Obviously the know-how is here, right? You know, guys, how to do this. Try to extra capitate, okay, extra corporate it, getting out of you on a paper. Sometimes people do like patent applications just for that, because I'm very, very ironic about patenting as a protection principle. We haven't talked about that, but it's a different story about all the IP, practical IP management. I used to run a company which was licensing things, right, for 8 years. I think I told you it's pretty much everything we had was IP. But I'm very critical on the benefits of patenting, by the way. Right. So, but anyways, you get out of the head. So make sure that everyone sees that that's a company. If someone, like if founders split at all the things you've done, stay with the company. There's no tacit knowledge you're losing at that point. That's very important for investors. Cap table straightened up. Maybe you have like loans, capitalize your loans. Even a small investor would be very reluctant investing into the company, which then has outstanding loans to its founders. Make it equity. Some other things. Yeah. And then fundraising collaterals, one-pagers, send-off decks, summaries, whatever they require. Now there was a trend and tradition moving away from one-pagers into the send-off decks, which is different from pitch deck, right? As you can imagine, because you're not the medium discussing it. It should be understood. Now it moves because of the AI agents analyzing all those things. Now the trend is moving back to one-pagers. There's more concise bit of information than send-off decks, but different investors would be liking different things. So just prepare all those information that can make a proper presentation of what you're doing. And very important, research, do the research on investors. Geographies, industry focuses, stages, investment theses, what exactly they're looking after, right? What kind of business models maybe, and start contacting them. I think nothing, let's ask guys tomorrow, but I think nothing pisses off the investors more that if you haven't done the homework and are approaching, I don't know, late stage biotech investment fund with your idea about the B2B early pre-seed, the need of investing in a pre-seed, I don't know, B2B software, or other way around. Because, yeah, just, hey, it's quite visible and obvious that this is not what we're doing. So why you haven't done just, you know, doing a cold shout out to everyone. This is really probably the worst thing you can do. Go to the reach out to the investors that are not the ones you need to look. Okay, process. Then you're reaching out. Sometimes people say, do always seek the warm intros, never reach out on cold. Beg to disagree. I would say there are pros, and of course, if someone can introduce you, very good. But my experience shows that if those introductions can play a very, very bad joke on you, because sometimes, especially if investor is not that experienced. And if the introducing person was kind of important to them, they will play along that they are interested and drag it, you know, until they will never invest. But because that guy is great, you know, professor of Stanford, like introduced you, they were there, especially the very high level, they will always say no if it's no. But the beginner investors, they go like, okay, but this is there's something in it, most likely because this professor introduced us. And this is, again, this is a downside. Think of the warm intro. Sometimes it's hard to drop you early, and they're losing your time. Not theirs, because maybe you remind yourself once in 2 weeks and they're not spending that much time on you. So I say cold outreaches and filling in those, most of them have some questionnaire forms and ways to send those send-off decks and one-pagers is not the worst thing you're doing. Another good reach out to, of course, is all the startup conferences and public pitching and whatnot. Public pitching is overrated. But this, of course, for the first external round raising, it plays a logical role. You never raise on just sorry. I am just writing that I will be a bit late. Okay. So try to be seen and visible, right? And keep on also warming them up. I've a story of one of the startups in Latvia who they just raised their first round in a few weeks because they kept, you know, seeding in the idea they will start fundraising. Here's how great we're doing. All the investor newsletters, of course, not offensively by permission, but they were doing that very well. Then you eventually at some point get into one-on-one meeting, one or many. Used to be always on site, now it's online as well. Sometimes you just needed to fly into the States or in London. I used to do that, but now luckily the pandemic has changed the habits, so people meet also online and don't bother. Then if you, again, it might not happen, it might go forth and back, but then eventually you receive the proposal called term sheet. And the proposal is the one which is all the things are outlined, which is conditioned upon the due diligence, most likely, or maybe some other things, mostly due diligence. So it says, okay, we are considering investing in you that amount for in that valuation and that rights and that, requests and requirements and all, setting all the thing up. And then you can negotiate the term sheet, of course. There is this exclusivity, remember, be careful with giving too long, or maybe none would be ideal, because you still can keep and get the other term sheets in and compare them. But don't ever pit them each. The worst thing, and because the investors talk to each other, there's more of a competition thing, not a competition. And if you start pitting, you say, oh, no, okay, we're playing games. We will thank you for the term sheet. We'll shop around for a better one or something. That's not the way. You may do it, but secretly or semi-secretly, but never tell it explicitly to them that you're currently, this is a your term sheet is a benchmark, and now we'll look to who's beating it, right? Something like that.
We can tell honestly. Well,
yeah,
our first offer of investment. We would like to talk at least to one or two.
The two things. Okay, you can say that this is your expectation of the valuation. That's fine. You said, okay, you gave this, but this is still we're looking for in the market. But this would be awkward if you say, we have received this. This is already on the table. Can you beat it? See the difference wording? I would not go that. That would be pissing them off big time. No, I see what I mean. You can say, okay, yeah, thank you for the term sheet. we still think we're here and we keep talking to others. Or let's see how much of the exclusivity is required, but we are still shopping around. That's one thing. But saying that, okay, going to the other fund and saying, we have, because it's a confidential, actually, this confidentiality, you can't tell the terms of others to third parties.
I would, but for example, I like one VC fund.
Yeah.
There's a good team, etc., etc. But they offer worse offer than another fund, which I maybe don't like. So is it normal? So if I go to this first one, which I like, I don't mention specifically which fund or whatever. I understand it's confidential, but anyway, honest to tell guys, we like you.
Yes.
But we have a better offer.
But what is better? Better financially. But
but
this is the not a better offer. You said, okay, again, you might say that we have better, but just careful of pitting. Okay. That's what I'm saying. Don't pit them against each other and don't call the names of something. You can say, yes, thank you. We would like to do the thing with you, but we have offers which are much better than this. Can you at least meet that or something like that? That's fine. But don't go like, okay, the X ones did this. Can you beat it? They go, screw you. I will talk to them not to invest in you now. Kind of thing, right? Because that's a closely knitted society, even the States, which is a big market. Okay. Then due diligence. Due diligence is checking whether there are not off-balance items and just if the data are truthful. I would say that for pre-seed investment, there are two items I can think of. This is super. Later stage, they already have paying customers, outstanding accounts and liabilities and whatnot, and that needs some due diligence. In the beginning, they check typically two things. If you have IP, like a deep tech, is it really registered on company? Not, for example, the patent belongs to university and you have no rights to use it, just in a handshake agreement. That's a no-no. You have to have some license agreement or maybe some IP otherwise like belonging to the company. That's one thing they're checking, but this is in a case that there is an IP. Most of startups don't have it. And the second thing they're checking if you're not tweeting drunk at Friday nights. And that's basically it. Because there's not much to check, right? There's not much of things going on there. Okay, and off-balance items, like I said, maybe you have an agreement to pay someone back. Maybe you have an agreement paying 20% of your investment round to some shady investment consultant doing the intro with those guys and that stuff, which is a big no-no initially. If you raise C round, you most likely will have investment consultants, but if not the pre-seed, don't. This is a bad thing, very bad thing. They're not going to fund your process. Okay, then you sign an investment agreement, then you issue new shares. Remember, those are always new shares. And then the investor buys them. And how you can ensure that, for example, for your 3,000 euro shareholder equity, you can raise 300,000 by issuing just 20% of new shares. This is called share premium. They're not buying at the face value, they're buying for the share which is worth €1 for 100 euros, for example, each of them. It's called share premium. That's sometimes I'm being asked, hey, how we can issue just 10% of new shares and get that much money, more money into the company as we had before in shareholders equity. That's simple. We just raise it on a different valuation, and which is kind of exercised through a share premium. Right, and then you write in trade registry, in commerce registers in this country, all the ownership rights. Okay, the last thing from my side, few tips. Just let's summarize, and I'm super thankful that some of you are still around, and I'm happy answering questions. I canceled my next meeting, so I'm free as a bird until 2 o'clock. Now, so first is really think of the right instruments. Remember the scalability thing, where you stand in develop your process, what you have accomplished, and look what is available, what's needed if you're about to fundraise. And remember, it's a necessary evil, as I said. I still believe that it's needed if you can't have the runway in other ways, and structure them correctly. Again, meaning that think of all the bridging, interim, long-term finance and that stuff. It's not difficult. You do not need, there's another thing. I believe personally, maybe I'm biased, but you do not need a CFO for that. You can do it yourself at that moment. Sometimes you may counsel with someone who's done it, but that's pretty much it. Sometimes I see that almost, people who are fundraising, they think that they institutionalized the CFO, some financial officer. Later, yeah, when you're already going into the seed or A round, you might need some. Okay, the very important thing is on the first level that also one of the biggest sources of dispute of founders, and subsequently also the reasons teams break apart, is fundraising strategies. Because some founders can think that we'll bootstrap to the world domination. And some founders understand that, yeah, because of this and that and our business model and need for runway, we would need to raise 2-3 rounds. And if not all the founders are in agreement that this is a good thing, or let's do this, it can cause huge problems. I've been through that as well. Part of my argument with one of my co-founders back then was that we needed to raise the round just to move faster. And the guy said, no, we raised 1 round and that's it. Exactly like we were having this discussion. We raised 1 round. What's the point? I said, no, but everyone will outrun us if we don't, because we needed to really burn some cash to move fast. And it went nowhere because he was biggest shareholder and he was vetoing. He was technical rights, 1/3 plus 1 vote in Latvia. He was a technical ability to block the fundraising, and company just died out because of the cash arm. That's simple. So you have to get an agreement that, okay, we all believe this is the thing we're going to do, because it will backfire. Sometimes, some of you have more shares than the others and you can impose the agenda, but this is a risky one. Then you agree on terms and structure. Does not prevent subsequent raising. The idea is don't sell too cheap if you're desperate, because the next round investors, if you need a second round or so, they will be suspicious. What was either those previous investors are crooks or you already did. And none of this is a good news, right? If a strange round has been done before, if it screws the cap table, that's an issue. Raise with some slack. I already spoke. Things take longer and are more expensive than you think. Again, whether it's a plus 50%, plus 30, depending on what is there, I don't know. But raise with some slack. Raise timely. Don't raise when you need the money tomorrow. That was an idea, what I said, that you can start, even if you pitch, for example, in a startup competitions openly, right? I like these soft calls to action sometimes. We go like, we know we're very early, we need to finish the prototype and do that like a pilot, and then this and that, and then we start raising in 3 months' time. Right? You kind of signal you'll be raising, but you understand you're not ready yet. You can't do it forever, but sometimes it's a very good CTA, sometimes a very good call to action, because if there are investors that are kind of interested in what you're doing, it's a very nice door opener for, hey, can I get your email and send you newsletters, promise not more frequent than once a month or something, or on how great we're doing, etc., something like that. And then you can warm them up to the point where you can when you need to raise, you're able to close the round easier. I'm not saying easy, but easier. That is the thing.
Theoretically, I need to start to think about next funding round already when I have burned half of the money, for example. But just for example, we will raise money for a year of 500K, and we're going good to our milestone, etc.
Mhm.
So, and already in 6 months, I have to start thinking about
Yeah.
next round already.
Yeah. This is thank you for this comment, and I will counter comment in a different way. I would, because of that, I would not suggest you raising for shorter runway than 1.5 years. This is exactly because you're kind of thinking we're raising for 9 or 12 months. You will, because of the fundraising is a full-time job, particularly for the CEO. So you will, the very moment you're closing this round, you're starting to raise the next one. But your company needs, like I said, it's means not rather than ends. The company needs you for building product, building team, building everything, right? And you're busy fundraising. Okay, we closed it. Okay, yeah. We will need the money in 1 year's time. Let's start doing that. See what I mean? So this is a full-time job, and if you can squeeze it, and that's why you need to warm things up and prepare slowly, and then end with this in ideal world. That is the reason why you're actually doing that. Because nothing smells so strong that desperation. Even the least experienced investors will feel that you're desperate. It's the last minute. You know, if I walk out without the contract out of your room, then I'm doing sepulchre or something, and that's it for me. That's really, it has a smell. It's tangible. Don't do it. Be the one who decides. Have 6 term sheets and go like, I don't like you. Yeah, why not? Let's talk. That is the position you want to end up. Again, this is an imaginary position, but you have to strive for that, which means all the idea of the funnel. Talk to 200, get, one-on-one meeting with 50, have, I don't know, 7 term sheets, 3 due diligences, 1 agreement. Bang. Not the other way around. If you talk to 1 or 2, no chance. Nothing will fall. This is like a selling, right? Strategic. If you have this 2 there, not 200, nothing is going to fall out here, at least not on your terms. Right. Prefer smart money. That is, again, brings us back to the beautiful conversation we had. The money per se is eventually starting to play a lesser role, at least in the beginning. You can bootstrap things or make them cheaper. So think of what else these investors bring to the table. And then it's back to the question about pitting them, because maybe this investor has worse financial terms, but you see the benefits of their intros, industry experience and whatnot. Most of the investors, most of the funds will tell you that they will open all the doors in the world, take you to the pinch of salt. When you're on their portfolio, not necessarily all this will come true, but still try to look into what else they can help you with. Maybe it's reputation. Sometimes you take money from super well-known reputable investors because you want to be on their portfolio in a sense. It may help you to sell if they're, specific industry related investors. Oh, these guys are invested in you, like, I don't know, BMW Ventures, right? We can think of asking what you're doing for the manufacturers, right? Maybe that's the way to think about it. But still, as my good friend Juha Rohanen from Superhero Capital says, dumb money is so much better than no money. So take the money if someone gives you. Think about it. At least not all, most of you can say no, but most of startups will never have the offer. Okay, very important thing: raise from people you have some chemistry with. Because if you see, it goes both for angels as well as for like fund managers. If you see that this is not going to go anywhere, there's something, maybe, I know it sounds silly and esoteric, but something on personal level doesn't click at all, be very careful. As you probably know the Murphy laws, right? And one of my favorite Murphy laws goes like this: what starts good ends bad. What starts bad ends worse. It will never be better than the courting period when they want you, you want them. So if you don't have any chemistry on a personal level with these partners in a fund and angels as well. Be careful. I'm not again saying that if they probably are some investor that is minority investor in the round, make sure that the lead investor in the round is not paying in a back, right? Sometimes they also will have multiple investors in one round. It's possible, even for seed rounds. Yeah, and the most important thing, and I think I end with that one, be ready to say no. Remember, and it's not even the AI thing, it has been always there. Early stage investment scene is super, super asymmetric. So the statement that there is no good projects to invest and the statement that there's no decent money to take are always correct, both simultaneously. This is very asymmetric. So you could look at that way, it's true, and look at the other way, it's true. So be ready to say no. The investors need good potential projects as much as you need investors if you need them. It's not like looking bottom up, right? They also are desperate in finding the portfolio companies which will dominate the world and return those X's, whatever are their theses, maybe they're revenue-based investors was not. So be ready to, so you're not the only ones who need it. They need it as well. And make sure you remember that. All right, guys, slightly over time, but I hope quite many actually were still around. Wow, pretty much only the 3 people have churned. All right, thank you. I'm still here for questions. If there are no questions, it's
one question.
Sure.
It's certainly not a short question.
Okay, or the answer will be short then, I promise.
I'll try to make the question short, but the answer is not short.
Okay.
What about valuations? So how should we think about that?
Oh.
Obviously there is like future growth, but like
how to think about it.
The multiples or like what are the basic maths for valuations? Because when it comes to, let's say, one thing that we touched on several times about this liquidation multiple, for example, like just understanding that the valuation is this. If the company is saying 3x liquidation valuation, but they're valuing you at the let's say optimistic valuation, you're being ripped off, for example. But just how to think about the valuation before all the other things.
Yeah, okay. There is the sophisticated way and the easy way, or the rule of thumb way, and both of them are actually not that different. So the sophisticated, the classical way how to think about the current value of any asset, and the company is an asset eventually, is to think of their value in the future, which is basically some sort of a function of their cash flow, free cash flow, whatever. But let's not go into that. Let's not go into the accounting, managerial accounting that much. But the idea is, there's a question. I'll answer that next one. So the idea is the following. So you can think of that. Okay, I'm an investor. I want to let's make it super simple. Let's simplify down for the mathematical purpose, because there will also subsequent rounds is diluting the first investors and everything. But let's take a super simple example. So I am the sole investor in that company. Just let's take one investment round, and I'm having, you know, I'm believing that this company can be exited in let's say 5 years from now at 50 million. Okay, 5 years, this company will be worth 50 million, and then Google is coming to buy it. Then I would go and I would say that I'm expecting the, I don't know, 10x, right? Which means that I would, in order to, this company grows together, there's no dilution and everything. If it's a 50 million in 5 years, It's 5 million worth now. Okay, okay. It's 5 million post money, because I'll get my money, and in order to return this 10x, they would be, and we believe and agree that's 50 million worth then. It's 5 million worth now, right? This is including my money. Now they are asking for 1 million, which makes me valuate the company 4 million pre-money, meaning that I'm taking 20%. Backward mathematics. And then we go, I put in 1 million for 20%. It grows into 50 million. My share is 10 million. I'm getting 10 million back in 5 years if we do it that way, but we can calculate. So this is the sophisticated. It implies the understanding how much the company will be worth, like in some time from now. And since if you're not still on a market, it's a very difficult exercise. It's just your word against my word, right? It's a hockey stick, like I'm saying. Is it like a flat, as the investor would tell, or is it like that, right? Like the founders say, just give us money, you'll be amazed. in 3 months, we'll conquer, you know, all the beachhead market. Now, the simpler version of that is a discussion of the future value coming from future cash flows and free cash flows. The simple version is simpler, but this is surprisingly similar, ends up with a surprisingly similar result. And this goes like that. Then, as a rule of thumb, you are not, for the first like pre-seed plus seed, if you have maybe 1 round, maybe 2 rounds, depending how you structure this, right? Until you are getting into the market and starting to have revenues, repeatable revenues, you are not giving away more than 20% of your shareholdings. Anything between 10 and 20 would be, so 15 is the medium, put it that way, for those first monies. And it may sound super silly logics, but think for a while. There is a certain justification in that number. Again, not the number of 15, but there's certain justification in this simplifying the rule. Because most likely, the more ambitious you are and the bigger impact, the bigger upside you have, the bigger pre-seed seed you need. There is a certain correlation. So for example, if you're raising 200,000, you can maybe grow into a few tenth of millions company, but if you maybe need to raise a few million before you hit the market, then most likely the expectation is that you will be bigger as an upside later. So this is a rule of thumb. Those 15 to 20 or 10 to 20 depends also on the supply demand. In America, all the valuations is much higher than in Europe, and in like London or Tel Aviv, they're much higher than here, or in Stockholm, for a reason. And that's not only expense thing. That's more of the expectation and the upside thing. Right. So this is how you can think about it. But you can play. You can like make a health check of this rule of thumb, like 15% for the first few 100,000, right? You can think in projecting that how big you could be or cannot be. And this is why all the market metrics like TAMS, SOMs, and all this ugly things matter actually for a smart investor, because they can do their own math. If you're not daydreaming, even if you're big, are you really that big? Okay. Or even if you need to pivot, which is often, you know, you think that's your market, but no, it looks like it's not the small enterprises, it's NGOs and the other way around and everything. They still want to see whether there is some healthy market you're attending to. That would be the thing. I hope I answered. Yeah, and then there is something here, which let me read it out. Yanis writes, what do investors expect to see during the due diligence? Okay, I touched upon that. That, of course, they want to see a clear cap table first, that there is no off-balance items that you probably, you borrowed, money from your cousin on a handshake and that haven't put it on the balance sheet. They definitely don't want to see that. They definitely don't want to see dead equity. Talk about dead equity tomorrow with Andres and Mix. That is interesting topic. What's dead equity? Dead equity is that's the reason why also the founders should be reverse vested. Dead equity is some people or organizations sitting on your cap table that are not contributing anymore. That could be previous co-founders which are not with the company anymore. That are my famous example, which I'm always have very strong opinion against, universities and research institutions that have given their IP to you and that's why they're sitting on your cap table. I would say don't do that. Do a good licensing agreement, a win-win licensing agreement instead, but not take those dead meat on the cap table because they give your, unless they're currently, doing research for you, that's different. But they just gave you some IP, but they're not contributing to the commercialization of it. That's an asset, right? Fine. Work through the licensing agreements. That's one. Another thing on the due diligence. But then again, if you have operations, you have accounts payable, you have liabilities, you have your debtors and everything. Of course, they want to look through your balance sheet and look and ask questions. What is this and what is that? And when this loan is due and whatnot, right? And are you required to repay something immediately out of which they would hate, that you have so piled up so many loans that all the round is going to settle the loans, and then you're again naked starting raising and all those things. What else? Like I said, if you initially, if you're pre-market, pre-revenue, there's not much except of this IP and know-how thing, of the commitment, that the question of are the team is committed full-time or close to full-time, very important. Investors are not going to invest into something that is still a part-time job for all of you. That's a big idea. You have to convey that even if you're not working full-time now, that the very day you will be raising, you'll be full-time only here, because they don't want it, they don't want it that you're splitting your time with whatever your activities. Again, if you're a core team, if you're an advisor, if you're kind of, again, scientific advisor to the team, keep it that way. And we may have even a small stake. Again, the keyword is small share, but the core team is there. What else? Yeah, then they check probably also on your previous experience as an entrepreneur, as a startupper. Maybe there are some reasons you're red flagged by some of the other investors. And then there's not necessarily, a no-go. It's not necessarily a deal breaker, because sometimes they also have reservations toward that investor who has red flagged you, blacklisted, because it's not necessarily all investors are thinking equally to that. What else? Clarity of cap table, no off-balance items, IP with the company, no dead meat on a cap table, which goes with the clarity of the cap table. Yeah, not much more than that in the beginning, if that was primarily fascinating. Thank you, Julia. You're great at compliments. I'm not sure it was so fascinating, but yeah. Right. Yeah. What else? Any last? Yeah, you have a question?
Taking into consideration your answer to the biggest question, does it make sense to order valuation in Stockholm before raising money?
Ordering, what do you mean by order valuation? Ask someone in Stockholm. It's no point, No. That's the idea. You do it. That's actually a nice, I will answer it sideways, but I think you will get partly, you will be satisfied with the answer. I used to, because they are technical valuation methods of the future cash flows and everything, which is done mostly in corporate world and sometimes even medium-sized enterprises. There are lots of, there's about 6 methods. One is the asset, which is not relevant. One is like exit value of lookalikes. You can see, okay, that somewhere, you know, in the state of New York, someone has bought the company for X amount, and that's why counting back, I'm worth that. That's silly either. And then there's the cash flows, obviously the future cash flows valuation, again, discounted back to this day, and few more. I used to know it because I'm hobby financier myself. I like those things just to laugh on them. But and I remember vividly, I was just sorry to entertain you with this silly story, but I was for about 3.5 years, I was part of investment committee of Georgian state of Georgia, not the country. Of Georgian sort of innovation grant, international innovation grant committee. So basically the idea, I saw like hundreds of Georgian startups and was one of the 3 people deciding whom to give a matching grant and whom not. Actually, very cool ecosystem nowadays. Unfortunately, they're losing country, but this is a different story. That was back then. That was better times for them. Anyways, and there was this, we had a like internal joke in a committee. There was one Estonian guy, one Israeli guy, and me who were the committee. Now, fun part. There was one presumably famous guy who was a financial consultant. And we even saw him because some were not shy putting him on the core team list as well, but he was just helping out with numbers eventually or something. And he was that guy. This was a kind of financial consultancy. I think he was somehow, because of the system as well, they also have this investment technology agency, a bit more advanced than our LEA, by the way, but that's kind of, you can get the idea. And he was actually, for some reason, maybe he was commissioned doing those valuations. And we had the internal joke that if the startup, because they had to show some ideas, because there was a matching grant, so they had to raise something on top of that, 50-50 basically. And when we saw that some startup came in with this, you know, the beautiful 6-column table always, where this accordingly to this method, and then there's a median and something, and we were literally taking off the points, because answering you, only the valuation of an investor, not a third party, matters. See what I mean? Investor is someone who wants to give you money on those terms, and you want to receive the money on those terms. And this is your valuation pre-money, and this is their valuation pre-money, and then you either agree upon something, depending who blinks first, right? Or you do it at convertible note or whatever is there. But having third-party valuations is laughing stock. I mean, these guys would never invest into your company. They just made up the numbers because they know the things. Do it. What I'm saying, do it sometimes as the health check, as the hygiene, seeing either you're maybe not going too cheap or not daydreaming. Do it like the same as with pricing. You never price on costs normally in startup, but do the cost calculation. Either you're in the red numbers or the black numbers, but this is not the primary pricing method. The same is with valuation. Never ever price on formula, but sometimes check it out whether you're not like by a degree away, like 5 times this or that direction. But largely this is like rules of thumb work, no matter how hard we're trying. I'm not sure I answered that, but I think, so asking for, if you raise in Stockholm, different story, get the term sheet and like constantly was saying, hey, by the way, we like you, but how about having better terms in Baltics? That's a different gameplay. But other than that, yeah, do it like just for hygiene exercise, but never think that this is something that, this is always an agreement between two parties. It's never a formula of any valuations I've seen in my life. And the sooner, the more the fact is true. The later you can probably, okay, have the, if you're raising the B, whatever, C, D, E, F round, you have a lot more discussion about discounted cash flows, right? Because you have them. Initially, you have none. That is the difference. Okay, fascination comes to an end. Yeah, any last question from the other side? If no, then let's end in style. Thank you so much. It was a pleasure. I'm not sure, was it recorded? It was definitely broadcast. Was it? Yeah, okay. It was definitely broadcasted. Thank you so much once again, and have a good Q&A session tomorrow. I think I warmed you up a bit. Just